U.S. markets are the deepest and most liquid markets.
We still see a lot of upside opportunity in U.S. markets.
I don't think we'll see a massive correction.
The U.S. has been really an incredibly strongly performing market.
We continue to be positive on the U.S.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good Friday morning. This week's geopolitical whiplash finally comes to a close. The U.S. benchmark struggles to hold on to a midweek rebound, set for its first back-to-back weekly loss since last summer. Add to that the dollar's worst run in 7 months and a Treasury sell-off. Are ebbing geopolitical risks enough to stave off a sell America trade? I'm Danny Berger alongside David Gura. John, Lisa, and Anne-Marie are on their way back from Davos. Hopefully they make it in before the snowstorm that's supposed to happen. David, I got to say, I said ebbing geopolitical risk, but that feels almost wrong to say, because sure, we backed off the worst of Greenland, but there are still threats out there.
Absolutely, and so we still don't have a Fed pick as well. That's something else roiling in the background. But yes, it's hard to believe this was a shortened week. I mean, 4 days in, it has been such a roller coaster ride over the course of Davos. And yes, we've backed off. We've seen the president back off that Greenland threat. But as we saw in that kind of all-night meeting in Brussels last night, this is still very raw and roiling, I think, for a lot of European allies. Some
of the rhetoric was just so fiery, whether it came from Zelensky, Trump himself, Mark Carney warning that this is a rupture, not a transition. It is assets that are weaker in the U.S. How much of, though, is that about that story specifically? Or is it just we've run up a lot, we're starting earnings season, but oh, by the way, Intel looked bad yesterday?
Forgot about earnings season as all of this unfolded. Yes, I mean, the Intel earnings are certainly important. We're going to talk about those, I know, but you mentioned that Mark Carney speech, and I think that's going to be the signal moment from this Davos. Yes, we had President Trump going there, the anticipation about what he was going to say about Greenland, but I think Mark Carney really laying that line down in the sand about a break here in the global order. I think that's going to have kind of ripple effects here over the next many years.
At least for today, though, it is back to business and maybe back to salting your roads and preparing for an avalanche of snow. For this equity market, it is another day of losses. We did have 2 back-to-back gains. That rally, though, no signs of showing up today. As David mentioned, it's Intel weighing on the NASDAQ 100. Yes, treasuries have a little bit of a better run today, but that follows a yields that were ticking up higher yesterday after not just the drama of the week, but also the fact that you had stronger data coming in. Coming up on this show, Ben Laidler of Bradesco BBI as the equity rebound loses steam, frankly, of HSBC as Intel plunges after a disappointing forecast, and Rebecca Homkeys of London Business School as investors turn attention to next week's Fed decision. We begin this hour with stocks pulling back on course for back-to-back weekly losses. Ben Laidler of Bradesco BBI staying constructive, writing, we are positive on 2026 despite renewed uncertainty, but with a fundamental outlook for resilient global growth, lower interest rates, high-tech-driven capex, and a continued rotation. Ben, I'm pleased to say, joins us now. Ben, good morning to you. I want to start on that rotation, because we have seen it. We've seen small caps outperform, emerging markets outperform, and you believe that this is going to be a year where value can show up. We've seen a lot of false dawns. Why is this time different?
Absolutely. I think this is a broadening sort of great rotation. I think it started last year. We saw international have its best year in over a decade versus the US. And now this year, we're just seeing it broaden. It's broadening by sector. Tech is lagging. Commodities, industrials, your top performers of the year. We're seeing it broaden by style. Value's doing very well. Growth is on the back foot. And I think this is driven by the fundamentals. Growth is firming up globally. We're still looking for interest rate cuts, but also the technicals. This is a classic January reallocation as allocators look ahead to this stronger growth and actually realize that they're very crowded in the US and in tech and probably don't own enough of these other assets.
Is there a sense, Ben, and this is something Julian Emanuel of Evercore has been writing about this morning, that after the sell-off of Greenland, of Trump-era uncertainties, that there's a sense that the deck has been reset, both in terms of positioning and sentiment and dispelled complacency. Is that fair? Is complacency now gone from this market after this week?
US equities are still flat for the year. We've had a little bit of a shakeout. I think this is as much more about the rest of the world than it is, about the US, right? We have markets in the rest of the world that are up 20% just so far this year. So I think it's a very positive rotation. You mentioned EM, LATAM have been the big beneficiaries of that. I think that will continue. But, the bottom line on the US, and I'm not negative the US, it's just we pulled all the levers already. We're on 22 times earnings. That's, close to a record for the S&P 500. Earnings expectations for this year are 15%. That's near twice average. And profit margins are at all-time highs. Tell me where the surprise is going to come from, which is going to take, US equities, meaningfully higher from here. That's what I struggle with.
Ben, I want to ask you about the lessons that you've learned from what we've seen over the course of this week. The rhetoric that we've heard, the speeches that we've heard, all of the pomp and circumstance, and President Trump taking Europe up to the brink. How do you think about that when you look at the VIX, hovering around 16 here, the level of complacency that we've seen here relative to all of that? What does it tell you about the market's attitude toward what we've seen from the president?
It tells me two things. It tells me that the market has learned to live with these elevated levels of policy uncertainty, but it also tells me the markets are very focused on the fundamentals. We have a US GDP nowcast sitting at 5%. We have the IMF, just the latest to take up their global growth, forecasts. We're still looking at a couple of Fed cuts. US earnings expectations, 15% for this year. The fundamentals, despite all that uncertainty, are very, very healthy, which is why, again, I'm not bearish on the US. I'm just much more bullish on a lot of other things.
We talked about the rotation, the geographic rotation. We've talked a bit about that over the course of this conversation. When it comes to the sector-by-sector rotation, you had a fascinating phrase. You talked to international tech as kind of a value insurance. And I wonder if you could explain what that means exactly and how investors are deploying that right now.
The tech outlook is great. We've got, we've heard from the supply chain, the sort of validation of these sort of 30% growth outlook, which is also what we're expecting from earnings season. So I think, but the problem is the valuation's already very high. You're paying 30 times plus earnings PE for that. I think what's interesting about EM is you have a very similar tech weight. So at least as dependent on tech in EM as you are in the US, except the valuations of the Samsungs, the TSMCs, the Tencents of the world are basically half what they are in the US. So by all means own tech, but I would, you say there's not a lot of insurance out there. The VIX is maybe a little bit complacent. I think some of the insurance for that sits in some of these cheaper versions of the sectors that you like.
Ben, in some of the run-up that we've seen in tech, it's come from those that exist in the AI ecosystem. When you look at an earnings like yesterday, where Intel not only misses, but is so punished for it in the pre-market, down in the teens. Is that kind of a playbook for the other big tech we're likely to get this week? Any near miss, is that a recipe for really painful losses?
I think that's the risk. I mean, as I look at, big tech earnings next week, the setup here is that it's all about tech. If you look at that 10% earnings forecast for the S&P 500 and you disaggregate it, it's all driven by this 30% tech number. So, if tech does miss, we're in trouble. And it's more about tech than it ever has been. I think some of the Intel issues are idiosyncratic. But yes, this setup of high valuations, high expectations, high margins is one, I think, that makes it difficult for you to get that surprise which is going to drive our performance. I think we're set up for a very average US year, and I think the room for surprise, given the valuations, given the expectations, is just so much higher elsewhere.
And again, this gets back to your point of valuations look more attractive for tech abroad than they do in the U.S. And underscoring that, too, is the fact that the Mag 7 has been lagging. I've heard it called the Lag 7, which I like, as corny as that is. Ben, what needs to go right for the outperformance of that market leadership to continue?
Just this 30% growth number needs to become a 40% growth number, and maybe we get that with with earnings next week. But we need to have a surprise versus already high expectations. And there's not a person on the planet that doesn't own big tech today. I think the bar is just set quite high. And again, elsewhere in other assets, other parts of the world, the bar is just set so much lower.
Hey, Ben, thank you so much for joining us this morning. Have a great weekend. Ben Laidler of Bradesco BBI. Ben was talking about surprises in tech for this market. Maybe here's one for you. Breaking news from our Bloomberg team just moments ago. China has told Alibaba, ByteDance, and Tencent and other top Chinese firms that they can start to prep NVIDIA H200 orders. There's been a lot of back and forth reporting on this as whether China would allow the orders of the NVIDIA chip or not, but this does suggest that they're moving ahead with plans. It's something NVIDIA has let out completely of their earnings, putting China at a zero. David, maybe this is finally a change. Does it signify cooling tensions or just the fact that Chinese tech firms need NVIDIA to operate?
I think they undisputedly need these chips, but I think you bring up that moment from the most recent earnings that NVIDIA had. I was so astonishing to hear that they'd put a zero there for that. And I think that they have been navigating this as the rest of us have with this huge element of uncertainty where this was going to be allowed. So certainly a huge move here that we're seeing from those Chinese companies.
Yeah, shares are up just more than 1%, still not completely the all clear. This is just in allowing them to prep for orders of the H200. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Lizzie Burden. Hey, Lizzie.
Hey, Danny. President Donald Trump continuing to push for access to Greenland. Sources telling us here at Bloomberg that the U.S. wants to rewrite its defense agreement with Denmark to remove any limits on its military presence on the island. The current arrangement, signed in 1951 and amended in 2004, calls for the U.S. to consult with both Denmark and Greenland before it makes any significant changes. Elsewhere, the Japanese yen whipsawing after the Bank of Japan left its policy rate unchanged at 0.75%. This as the central bank says that it needs time to assess the impact of last month's rate hike and weighs the outcome of the upcoming snap election. The BOJ also raised its inflation outlook and left the door open for an early rate hike. Meanwhile, Chinese officials have told the country's largest tech firms, as you were discussing, that they can prepare orders for NVIDIA's H200 AI chips. Regulators have granted in-principle approval for Alibaba, Tencent Holdings and ByteDance to move to the next stage of preparations for purchases. Beijing will encourage companies to buy a certain amount of domestic chips as a condition for approval. And that's your Bloomberg Brief. Danny.
Lizzie, thank you very much. Up next on the show, Canada strikes back.
Canada lives because of the United States. Remember that.
Canada doesn't live because of the United States. Canada thrives because we are Canadian.
Terry Haynes of Pangea Policy joins us next. You're watching Bloomberg Surveillance. Headed for a first week-to-week, back-to-back losses since June for this equity market. Tech tries to turn it around this morning. First, it was Intel earnings that sent the benchmark lower. We eased off of that. NVIDIA is rallying this morning after news that China is allowing some firms to prep for H200 orders. But overall, its stocks ending an exhausting week on the back foot, although NVIDIA tries to fight back. Bond yields, those also ease off the worst of their losses this morning. Yesterday, it was about stronger U.S. data. Earlier in the week, it was about Greenland, and it was about JGB yields moving higher. Japan, a continued source of volatility, but at least for this bond market, a sleepy morning. Under surveillance this morning, Canada strikes back.
Canada gets a lot of freebies from us, by the way. They should be grateful. Canada lives because of the United States. Remember that.
Canada and the United States have built a remarkable partnership in the economy, in security, and in rich cultural exchange. But Canada doesn't live because of the United States. Canada thrives because we are Canadian.
Here's the latest. President Trump withdrawing Canada's invitation to join his Board of Peace as tensions soar with Prime Minister Mark Carney. Carney previously saying Canada would join the board before shifting tone and urging countries to band together against U.S. threats. Bloomberg's Tyler Kendall joins us now. Tyler, whoever said that Davos wasn't important? Here we are on the world stage, two leaders hashing it out. Where do we end this week?
Yeah. Hey, Danny. I mean, this is the most recent escalation in what has been increasingly tense relations between the U.S. and Canada. And you're exactly right. This appeared to have started in Davos, where we heard the Canadian Prime Minister Mark Carney in his speech not name President Trump, but it was widely seen as a sharp rebuke of this administration's and its policies, particularly around trade. And in response, as you just mentioned, the president has withdrawn. Another centerpiece that happened in Davos, the signing of the Board of Peace, even though Mark Carney had already accepted the offer in principle. And President Trump, of course, didn't hold back in name-checking Carney in his speech. But this feels like recent escalation, a recent tit for tat. But we have to keep in mind this relation has long been strained. Carney largely campaigned on countering this White House's trade policies. And there has been mounting frustration on both sides when it comes to a lack of progress on a trade deal. While, of course, the majority of Canadian exports to the U.S. are covered by USMCA, there is still some big exposure on some of those sector-specific tariffs for Canada, such as steel, as one example. That's actually led Carney in recent months to declare that he now has this goal of doubling non-U.S. exports over the next decade, and that's contributed to him reaching out to some other countries, including China, which Carney called a better trading partner than the U.S. just last week after the two countries inked a new trade pact. So a lot there that this could ultimately develop into. But Danny and David, the U.S. Commerce Secretary Howard Lutnick was actually on this program yesterday. He largely dismissed Carney's moves as what he called, quote, political noise. But to your original question on where this is all going, we could potentially see impacts when the USMCA is renegotiated this summer. Lutnick had suggested that Canada's tilt towards China could complicate those matters. Now, it faces this mandatory review, but there is real talk that the renewal may not be guaranteed, depending on how Washington views all of this.
Tyler, thank you very much for your reporting all this week. That's Bloomberg's Tyler Kendall. Joining us now is Terry Haynes of Pangea Policy. Terry, Dave and I were talking about this at the top of the hour. Mark Carney of Canada saying that this is not a transition, this is a rupture. To what degree did you see the events of the past 5 days a rupture?
I saw it mostly as political noise, frankly, Danny. You got a situation here where, you know, sort of Trump's dismissal and abuse serves Trump's political purposes. Carney's responses serve Carney's political purposes as well. As Tyler points out, this was integral to exactly why Carney is Canada's prime minister right now. But the most important speech out of Davos for me this week was Zelensky's, in no small part because what Zelensky did was validated the United States view of the world that Trump, and I think by extension Canada to some extent, isn't living up to its commitments and had better start.
Interesting criticism from Zelensky there about how Europe is focused on the future, not on the present. Let me go back to Mark Carney, if I could, because, yes, that speech at Davos was the capstone to a big trip that he took. He was in China and the Middle East before that. And that's kind of where I want to go with you, Terry, as we kind of play this out. He seems very proud about the fact that Canada is a middle country and is calling on middle countries to kind of get together. And I wonder, okay, I'll give you what you say there, that maybe this was some political noise. How about the substance of the trade deals that he brokered and announced on the course of that trip leading up to Davos? What does that tell you about the way that he and other world leaders are pursuing alliances in light of what we've heard from President Trump, in light of the behavior from President Trump over the course of this week?
Speaking, David, it's vastly overblown to assume that because there's some elbowing under the basket or elbowing in front of the goal in Canada's case between the United States and a variety of European leaders that the Western alliance is going to rupture. It's not as if China is kind of just another country out there that will be interested in having Canada pursue its course just as the United States, economic and in every geopolitically and in every other way, just as the United States does. The Chinese playbook is very different, and Carney, I think, wants to set himself up as Václav Havel for his domestic audience. audience and maybe part of a world audience. But what he's flirting with is turning into Fidel Castro, where he's picking superpowers, and that will create a larger problem for Carney specifically on the world stage. As of Europe, Europe is having a hard time getting out of its own way, as Zelensky famously said. And one thing that's happening with Europe is, they spent 25 years negotiating a South American trade agreement called Mercosur, and as soon as it's done being negotiated, they slough it off to the European Court of Justice to try to pick it apart yet again. These are not people that are serious about picking themselves up off the ground, and that's unfortunate.
On the issue of serious men, I want to get your perspective on what we've been through here vis-a-vis Greenland, Terry. So we had the president causing this storm, causing this stir at Davos, coming to some sort of framework agreement with the NATO Secretary General. Those conversations will continue. Why did he put us through this? We know about the agreement that's in place with Greenland. How much better, or how far have we advanced this story here as a result of all of this happening when it comes to the U.S. staking some claim to or advancing some projects in Greenland and using it to secure more security in the Arctic?
Well, a couple of things. One, I think markets are not so concerned about the how. They're much more concerned about the what and the why. They've been through 10 years of Trump and Trump's methods. So that's I think that gets overblown elsewhere. And I think it's important, by the way, but it gets overblown compared to what markets care about, which is, where are we going next? Number one. Number two, you have two choices on why the United States' hair is on fire about Greenland. One is that Trump's a fool, an idiot, and all the rest. I think that's largely self-comforting. The other is that we've had, at least for the past 4 years, the highest geopolitical risk in 50 years, and the United States is scrambling on a lot of different fronts: economically, defense industrial base, taking stakes in companies that are interested, they're rare earths and minerals and all the rest. Kind of realigning its economy to deal with the competition from China, and markets are just now catching up to that. They seem to be generally surprised by it, but they shouldn't be, and a lot of that's the way it's going to be going forward.
Terry, I just wonder then, in your mind, does this week solidify that Trump will back off the most hawkish, the most extreme, the most concerning of his policies?
I'm not sure what you mean by that.
Well, in this case, I mean using force in Greenland. Is this market, when it sells off and then people buy the dip, assuming a taco trade or whatever, is that play still at hand?
I think anybody that's in this and thinks that what's been happening is taco or backing off is kind of lost the plot, frankly. The United States interest has been consistent throughout, and it's not different than the interest in Venezuela, frankly. There were two priorities in Greenland. First, to improve United States and Western national security in what's now being called the far north. Secondly, was to gain greater access to minerals and rare earths. That's the through line, and that's been the Trump administration's interest, and that's how they're going forward. As to Trump's methods, I don't defend them. At the same time, I'll look back at Europe, I think, for potential justification. It has taken 10 years, 9 years really, but 10 years of the United States jawboning, saying, look, you need to meet your NATO commitments, your defense commitments, get yourselves together. Still hasn't happened. What ends up happening at the end of this is that, Europe want to say Slava Ukraini and say, well, we're with Ukraine till the end. And Ukraine's own leader says, you could be doing twice as much as you're doing right now. You're not doing it. You're putting us in peril. You'd better get your acts together. That's why I say Zelensky's speech was the most important of the week, because it validates the United States' frustration with Europe.
Terry, we're going to have to leave it there. Thank you so much for joining us. Terry Haynes of Pangea Policy. And David, also coming out of this, we're going to get our first trilateral meeting happening in Abu Dhabi, I believe. We'll see whether that adds more to Zelensky's speech.
Yeah, and I think he, like a lot of people, is probably gravely disappointed by how little progress was made in Moscow last night when Jared Kushner and Steve Witkoff went there for Steve Witkoff's 7th meeting with President Putin. We'll see if at that kind of lower level they're able to make more progress in the Middle East this weekend.
First, coming up, though, on this show, Frank Lee of HSBC as Intel's disappointing forecast sends shares tumbling, plus Vonnie Quinn with your movers of this morning as NVIDIA up this morning, up 1.6%, China clearing the way for H200 purchases. You're watching Bloomberg Surveillance. It's hard to believe this has been only a 4-day week. It's a week that's felt like a year, and for this equity market, it's been a not so nice one. We are headed for 2 weeks of losses, but trying to fight back this morning off of the lows thanks to NVIDIA. Vonnie Quinn will have that in your movers in just a moment. The tug of war between what wins out an Intel sell-off or NVIDIA gaining this morning. Russell 2000 underperforms. I do want to point out that they have had 8 record closes so far this year. That means that they've outperformed the S&P for 14 days in a row. That's the first time that's happened for the small cap index in 30 years. When it comes to your bond market, it has been a range finally exceeded. We were little moved on this bond market, and you get a big jolt this week, be it from the geopolitics of Greenland or be it from JGBs. More drama, though, in Japan this morning. After you had a Bank of Japan decision where we don't get clarity on where we're going, you see a yen that sells off, and all of a sudden, a plunge in dollar yen. David, people looked at this exact moment and said, is it intervention? Is it something else?
No, an unanswered question. I think the finance ministry demurred when was asked about whether there had been some intervention here, but something I think we're going to track here over the course of the day. But yeah, an astonishing move there on dollar yen.
And it could have just been channel checks.
Sure.
But if it was an intervention, it does speak to this idea that the trend has been weaker dollar. The MOF doesn't step in unless the trend is in their favor. And the trend has been sell U.S. assets and sell the dollar, at least for the past week or so.
Many lessons learned here over the course of this shortened week. One was from Ken Griffin talking to our Eric Schatzker in Davos, saying don't underestimate what we can learn from Japan and what's happening there. So here maybe another lesson in that textbook that we're seeing written in real time.
That's for sure. International markets having a big role to play here in the U.S. 3 hours away from your cash open, let's get some morning movers with Vonnie Quinn. Morning, Vonnie.
Good morning, Danny. Well, you mentioned it. We saw futures improving. They might still be pointed lower, but this is why they are improving. We're seeing NVIDIA off its highs, but it just jumped pre-market when that news hit the wire that China officials have started telling the hyperscalers like Tencent and so on that they can start preparing for ordering H200 chips from NVIDIA. Now, we know that some of them have told NVIDIA privately that they plan to order as many as 200,000, so it would be a boon for NVIDIA and also put to rest all of this waiting and watching and wondering whether NVIDIA can actually ship its H200 chips to China. Of course, it's giving TSMC, the manufacturer, a boost as well. And obviously, it will also, sort of hurt some of the Chinese AI chip manufacturers like Huawei, who had been trying to sort of get a march on NVIDIA. So definitely one to watch for today's session. Now, let's move on to Intel, because certainly not the case for Intel. Intel reporting earnings and really disappointing investors. Now, bear in mind, we were up almost 15% this week alone on Intel, so perhaps investors getting ahead of their skis a little bit. But Lip Bhutan basically giving a very disappointing forecast, also saying that they had hit manufacturing snags. Look, anyone watching Intel would know that this has been the story. Neil Campling of Bloomberg News earlier saying that Intel has suffered under the last 3 CEOs and is a decade behind. And just one figure for you. Intel used to be obviously the biggest semiconductor company in the country. NVIDIA is now 17 times the size of Intel, so that'll tell you how much it's suffered. And then moving to the financials, we also got earnings from Capital One Financial, down 2.4%, but it is making an acquisition of a fintech company, Brex, for more than $5.1 billion. Capital One said revenue was up 53% in the quarter, year over year. But some interesting comments from Richard Fairbank. He said, if the credit card cap of 10% goes into effect, that might actually cause a recession, which was a very strong comment from the CEO of Capital One Financial, Danny.
It certainly is, and those shares off 2.4% this morning. Bonnie, thank you very much. We'll catch up with you in the next hour. On our radar this morning, the United States is reportedly seeking to rewrite its defense agreement with Denmark. Sources telling us here at Bloomberg that American negotiators want to ensure the U.S. faces no restrictions on its military presence in Greenland. Elsewhere, the Kremlin saying territorial issues remain unresolved after President Putin met U.S. envoys in the latest push for a peace plan. This all coming after U.S. President Donald Trump said he had a good meeting with Ukrainian President Vladimir Zelensky in Davos. And back in the U.S., TikTok and its Chinese parent company ByteDance closing a long-awaited deal to transfer parts of their U.S. operations to American investors. The move securing the popular video apps feature in the U.S., David, and avoiding a nationwide ban.
Yeah, interesting to kind of look at what configuration this is going to take, and we know who the investors are who are involved here. So it's Oracle, Silver Lake, and MGX. I think some unanswered questions yet. Does this satisfy what was in that law? And you mentioned this kind of long-awaited deal. This has been something that was extended and extended and extended again. So this is something that's been in the works for a while, obviously, but we'll be interested to see sort of what this next iteration of TikTok looks like, how, in a very granular level, this is going to be run here in the U.S.
And that's part of the confusing part of this, right? That you still have ByteDance licensing the algorithm, I guess, to U.S. TikTok. It doesn't own it. ByteDance still gets a valuable hold in parts of the business like e-commerce. In what world does that satisfy national security concerns? And this is a law that was bipartisan, that both sides agreed it was an issue. It feels like maybe because this president enjoys TikTok and thinks it got him elected, then maybe they're able to ease off a little bit of the harshest criticism.
Yes, not an avid TikToker, but someone I think who understands the power of this medium, of this platform. And we saw him late last night chiming in on Truth Social, thanking President Xi for doing this. So I think what you're charting here is this really stark change or evolution in tone from the president when it comes to being quite hawkish on China vis-a-vis social media, now thanking the Chinese president for his efforts here and going along with the plan that the president hatched.
Well, putting that tech drama aside, another one taking hold this morning in Intel. Shares plunging after the chipmaker's revenue and earnings came in well below expectations. Intel also gave a disappointing forecast, with CEO Lip-Bu Tan warning of ongoing struggles with manufacturing.
We remain focused on the long-term objective of building a world-class wafer and advanced packaging foundry. Building a foundry business will take time and considerable effort and resources.
Frank Lee of HSBC upgrading the stock earlier this week to hold from reduced, but writing, we have been cautious on Intel's foundry business, driven by execution issues and lack of visibility on its external customer pipeline. Frank joins us now. And Frank, you and I were just talking about this yesterday, the fact you wanted to see more of that visibility. Were you too, much like this market, let down by the results we got from Intel yesterday?
Yeah, I think the key thing was we were bullish about server overall demand, CPU demand, and I think they reiterated that message. But I think what was disappointing was the guidance was disappointing given the fact that demand is so good, especially in data centers expected to be down sequentially quarter and quarter. So I think that speaks to the fact that they are still having some of their own production issue, execution issues. They've also maybe hampered by ongoing component issues, such as memory prices have continued to go up and continues to remain quite tight. So I think if you look at it, the overall results was disappointing on the guide. The positive part is that demand is good, but they haven't been able to deliver so far on the execution.
And say usually it's a good problem to have when demand is so strong that you can't meet it. Frank, how much of it is about that piece versus execution problems?
Yeah, I think the other thing that also perhaps the market got a bit overexcited was the foundry piece. This is an area where we've generally been more cautious. I know there's been a lot of speculation in the last couple of months about, more companies want to sign with Intel, want to do deals with them. And we've acknowledged that there's engagement, but engagement and actual orders and actual revenues are two different things. And I think this time around, they continue to express that they're not looking to invest in Intel 14A until they have something more solid. So I think that is one of the other issues. The stock is some of it could also be expectation behind a foundry business got a little ahead of itself.
Frank, this is an existential question, but I'm curious if Intel knows what it wants to be going forward. So it still has pretty relatively new leadership here. I think a roiling question has been, should it produce chips and design chips? Can it do both of these things if its aim is to compete with its rivals? How do you see this company's effort to kind of go through, again, that existential question of what Intel is in the year 2026?
Yeah, I think that part of the issue is the story has gotten complicated because they have this foundry business, which has been very questionable in terms of whether that's the right business to do. But there's also, I think, a lot of pressure from a geopolitical point of view to have, a domestic foundry player in the U.S. So I think that's the difficulty, is that if it was just about the core business, the CPU business itself, it's a much simpler story, because that means they are benefiting from strong demand. We're talking about server demand also being now more and more linked with AI and with agentic AI. But because of the complexities of having this burden of doing foundries, I think that continues to be an ongoing drag for them.
Talk a bit more about that pressure, because there is a lot of interest, dare I say, from 1600 Pennsylvania Avenue, other folks in Washington, in making sure this company can compete, obviously taking a stake in the company as well. How is that manifest in the earnings that we got here? How does it manifest in the business today? Sort of, how are you seeing that kind of show up in the way the business is being run right now?
Yeah, it's just too early to tell. I mean, I think, that's one of the issues, is that, as you build out the foundry business, it's a very long lead time. It takes several years. This current generation of their node, the 18A, we're not seeing very much progress. For 14A, which is probably the next real milestone, we're probably at least 2 years away from seeing any contribution. So it's still going to be quite a bit of a long road. I think one positive light is that they did highlight the packaging. Now, part of the issue with AI in the last 2 years has been the packaging has been one of the greatest areas of tightness. So we may see an earlier breakthrough there in terms of external customers, but the revenue opportunity for packaging is still going to be much smaller than what they would get on the front-end foundry.
Hey, Frank, only a few moments ago, our reporters on the tech team at Bloomberg signaling that China has told Alibaba, they've told Tencent and ByteDance that they can start to prep orders for H200s from NVIDIA. There's been a lot of back and forth reporting on this, whether China would allow or not allow it. How much faith do you take in China making this move, and how much does it change for you, your view on NVIDIA sales?
Yeah, that's a good question. We've generally taken the view that it's too difficult to take a stance on the China situation because of the uncertainties around the geopolitical side, around the trade side. So we have generally not included the upside in China into our revenue numbers. And we've been saying that, NVIDIA, while China is nice to have, it doesn't contribute as much to the overall growth as people think. I think NVIDIA will have a very strong year with or without China. But I know obviously the China part of the business does tend to have a more big impact in the near term as far as sentiment. But as far as our numbers, and I think for most of the street, we think they can get to $350 billion in data center revenue this year, without even considering the China part.
Frank, how is NVIDIA kind of looking at this? We know that they haven't been in talks with the Chinese directly here. They're kind of sitting idly by as all of this unfolds. Obviously make a huge difference to the business if this were allowed to happen here. But as Danny pointed out at the top of the show, you look at the last earnings from NVIDIA, they're not taking anything for granted here when it comes to China. Give us a sense of the psychology within NVIDIA when it comes to China, how they're thinking about this and the prospects of it affecting their business.
I think they definitely will like to see that opportunity. I think it's a big TAM opportunity to be part of, but I think there's also realistic that it is not entirely in their hands. In terms of being able to tap that market. I also think that there's also a recognition that the Chinese is going to look to develop their own in-house chip making abilities over time, like they have with other areas. So there is always going to be on the backdrop that, while we're able to get into China, at the same time, the Chinese are going to look increasing their self-sufficiency over time. So that is, I think, is always going to be there. Even if they can start selling to China, that doesn't take away that longer-term overhang.
Frank, that's kind of where I wanted to leave this on. This idea that this not just being a move of easing geopolitics, but rather a China tech sector that needs NVIDIA. How far does it seem to realizing that goal of China, to having a homegrown chip maker that can displace NVIDIA?
It's not going to be quick, and I know it's not going to be any. But what China, I think a lot of the AI language models, what they're proving to do is they've been looking at being more efficient and not being able to rely on the highest end chips to be more efficient. So that's going to be something we need to continue to watch. I mean, that was basically a DeepSeek moment last year, was that they were able to make some breakthroughs. So I think this is something that we can't, that we'll have to watch. And I think, while, it is a big headline, our thesis, and I think most of the analysts, their thesis around NVIDIA is still largely just the ongoing AI data spend globally, not just really on the China part.
Hey, Frank, thank you so much for joining us. We really appreciate your time. That's Frank Lee of HSBC. Let's get you an update on stories elsewhere this morning. Back with your Bloomberg Brief, here's Lizzie Burden. Hey, Lizzie.
Hey, Danny, we've got gold and silver rallying at the moment. The yellow metal on track to gain nearly 8% this week, closing in on $5,000 an ounce. Silver hitting an all-time high just below $100 an ounce. This rally in precious metals is being driven by renewed geopolitical risks and the weakening US dollar, which is on track for its worst week in 7 months. Elsewhere, TikTok and its Chinese parent ByteDance closing a long-awaited deal to transfer parts of its US operations to American investors. The social media company has officially established a US entity with 3 managing investors: Oracle, Silver Lake, and Abu Dhabi-based MGX. The move secures the app's future in the US after a years-long geopolitical and regulatory tug of war. And President Donald Trump is suing JP Morgan and its CEO, Jamie Dimon, for at least $5 billion, alleging that the lender stopped offering him and his businesses banking services for political reasons. The complaint accuses the bank of trade libel and breach of implied covenant of good faith. JP Morgan says the suit has no merit. That should be my brief, Danny.
Lizzie, thank you very much. Up next, awaiting the next Fed chair pick.
I'll be telling you soon. No, I have somebody that I think will be very good, but I'm not going to reveal it.
Rebecca Humkis of the London Business School joins us next. You're watching Bloomberg Surveillance. On track for back-to-back weekly losses. To round out a holiday-shortened week, your S&P 500 futures down by 0.1%. Same goes across the board. Tech, yes, some underperformance, slightly more underperformance from the Russell 2000, despite a broadening trade that had been outperforming with the Mag 7 down on the year, while the Russell 2000 continues to hit new highs. We, of course, take a break from that today. This bond market much more calm than what we've seen this week. This week is also one where we've seen a 420 handle on your 10-year bond market after trading in the high teens for much of this year. A breakout being led by both Japanese market and the Geopolitics and stronger U.S. data today. The curve lower across the board this morning, down by about a basis point. Your 30-year yield standing at 4.82. Under surveillance this morning, awaiting the next Fed chair pick.
I'll be telling you soon. No, I have somebody that I think will be very good, but I'm not going to reveal it yet. Somebody that's very respected, very, very well known, and will do, I think, a very good job. Yeah, probably.
Here's the latest. Investors awaiting the Federal Reserve's first rate decision of the year as President Trump teases his pick for the central bank's next chair. Rebecca Humkis of the London Business School writing, quote, both aspects of the Fed's dual mandate continue to move in the wrong direction, albeit slowly. Next week's Fed decision is unlikely to deliver clarity, and that's okay. Rebecca joins us now. Rebecca, if that doesn't deliver clarity, does a new Fed chair pick give this market some clarity?
No, good morning, Danny. Thanks so much for having me. I feel like we have been teasing this new Fed pick for months at this point. And, I think we're almost in some way overdoing it. Yes, the Fed chair does have a lot of power and influence, but voting on interest rate decisions are still a committee decision. One person coming in is not going to completely revamp all the agenda that they have right now. And I think we do need to take that in mind, especially as we're going to become quite obsessive over who this new person is, one of the Kevins or somebody else. And I'm hoping that we do get some clarity on that in the next month or so, but I wouldn't be surprised if this drags out for several more weeks.
Yeah, you say one of the Kevins. It does appear that we're down to one Kevin. We'll see how exactly that shapes up.
This week,
I don't know. See. He could be back in the running. We could add a Kevin. Who knows at this point, Rebecca? In looking at the list of candidates, are there any you're particularly concerned about for moving, let's say, the bond market for fears of Fed independence? Or if we've whittled it down to Kevin Warsh, Rick Reeder, and Christopher Waller, and Kevin Hassett falls by the wayside, are those three candidates that are unlikely to cause serious ruptures?
Yeah, again, I'm not concerned about serious ruptures with any of those 4 candidates that we're looking at right now. There is some concern that Kevin Hassett being so close to the administration might still be leaning a little bit too much on administration agenda versus this very critical central bank independence. And I think that's why we're pulling away from that. A couple of months ago, we thought Kevin Hassett was the shoe-in pick, and it looks like we're back to some of the others. All of these names, though, are respected economic officials. And again, I do need to emphasize we have a historical basis. Once this individual joins the board, it is a voting by committee, and I'm hoping we're going to see the same thing in this instance as well.
Let me stick with that and draw on your expertise counseling executives. So yes, this is a committee. This person's responsibilities are going to include trying to develop some consensus among members of this board. As you look at those finalists, what conclusions can you draw about their capacity to do that? I don't know if the president is asking each of them about their management style, but can we learn anything about how they might run this Fed from what they've done previously?
What's interesting is we've really had different styles of leadership over the past decade or so. Chairman Greenspan ran a very centralized, he was a much different leader. Ben Bernanke went much for consensus. We didn't have Janet Yellen in for very long. We're learning a lot over what Chairman Powell is doing. And we can handle that. The Fed is an independent body. Different leadership styles are to be expected, and we've seen success from different ones. I'm not quite sure what President Trump is looking for in the new one, but we do know that he very much values loyalty, and that's probably part of the decision. And again, what we really want to see is that whoever this pick is, once they're in this new role, they recognize and respect the importance of this federal grant independence that is about looking at the economy in a more holistic view, not just narrowly into the administration's view.
Davos is coming to an end.
It
John,
has.
Lisa,
What a week.
Annmarie coming home. I'm very curious what you've observed about the way that corporate leaders have comported themselves at the annual meeting of the World Economic Forum this year. There was that kind of signal moment where Zanny Beddoes was interviewing Jamie Dimon on stage. He kind of got ahead of her, anticipating what she was going to ask him about, gave this 20-second answer about his outlook on Europe and on trade policy. The next day, he gets slapped with this $5 billion lawsuit by the President of the United States. We had a piece on the Terminal this week just about the delicate dance that executives are doing when it comes to President Trump. What did you observe just about the way that they're acting, the way that they responded to, yes, the kind of geopolitical maneuvering we saw from the President, just the way that he's treating the corporate sector as well?
It is a different environment, right? And we saw this a bit last year. I think one debate we're not having this year, which we normally have the Friday after Davos, is does Davos matter? So at least this is one debate that we're not having this year. We are getting in a news cycle and environment where there is a lot of noise. We are not even once talking about what happened, just a week and a half ago with kind of the sieving of Chairman Powell. And I think we've almost normalized this level of volatility in the news cycle with these almost personal attacks if you don't show loyalty. That was absolutely a big story coming out of Davos this year, is a lot of behind closed door meetings about how different executives were handling the administration, what they were doing. We saw executives, I think Bloomberg even reported on it, not leaving parties until the president got there. It is a different way of governing. But look, CEOs, what side of the political aisle you're on, your number one priority is to your stakeholders and shareholders. And you are doing things that, reflect the stakeholder value of the company. And that is their role as a fiduciary. And we are seeing a lot of that. Personal belief that, this will go away as well, this current, suing of Jamie Dimon, which I think we got the news about. This will probably pass as the other ones do. It is just a very standard negotiation tactic, but this is just the new norm that we're going to have to learn to operate environments in. And it is challenging, an additional day-to-day pressure, an already pretty heightened economic and geopolitical environment for executives to lead their organizations through.
Hey, Rebecca, a great note to end it on. Thank you so much for joining us this morning. Rebecca Holmkiss of the London Business School. David, that's literally the exact point you made to me when we walked in this morning, that for everyone decrying, does Davos matter? Should I even attend it? Which I'm sure you and I have both heard from many biz executives who have said that. It sure mattered this week.
Yeah, I think on the whole spectrum there, world leaders who were gathered there, the speeches that they gave, as we talked about with Terry Haynes earlier in the hour, from Zelensky, from Carney, from Trump, it seemed like an important place to be where important conversations were happening, and we can debate the kind of outsized role that President Trump played in light of the whole Greenland story. But this was a place and a time that seemed to matter more than it has in years past.
You mentioned that tension with executives. Ken Griffin, in speaking to Eric Schatzker, basically called out executives saying, you should be speaking out, that yes, the president might troll you, he'll have those moments, but he does listen. I wonder if this is a president, especially after the lawsuit of Jamie Dimon, whether he really will listen. Okay, coming up next, Margie Patel of Allspring Global Investments, Ashley Davis of S3 Group, British American Business CEO Duncan Edwards, as we look at transatlantic relationships, and Kay Her of JP Morgan Asset Management, with stocks heading for another week of losses. You're watching Bloomberg Surveillance.
We've invested significantly in the U.S. economy.
We've got one of the strongest economies in the world today.
We're constructive that inflation's more under control. People have been predicting the U.S. to be at some type of decline from an economic point of view. None of that's actually happened.
We have good inflation. We keep on powering forward growth.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City, good morning. The second hour of Bloomberg Surveillance starts right now. A week cut short by a Monday holiday felt anything but short. A 4-day stretch of Greenland worries and Japanese market drama weighing on U.S. assets. And a once sleepy Treasury market sees yields hovering around the highest since September, also boosted by stronger U.S. data. All of that just as the president says, once again, that his Fed pick could come any day. I'm Danny Berger alongside David Gura. And David, I mean, of course, we've heard this before, that the Fed pick could come any day, but maybe it comes in the next week and overshadows the Fed decision.
Yeah, I think it's so important to look at this through the prism of realism. What is this person going to do or be able to do? Anna Wong, our chief U.S. economist at Bloomberg Intelligence, writing about Bloomberg Economics, writing about Kevin Warsh, who has been seen for so much of his career as somebody who's been an agitator for reforms within the Fed. Would he, in fact, be able to do that if he's placed in this position? Yes, he was a Fed governor before, knows the way the mechanism works. But again, going back to realism, one thing to opine on what it should be doing, another thing to kind of run this giant mechanism of more than 1,000 people.
Sure, and when he was a Fed governor, to be fair, and I believe Anna Wong points that out, and I'm glad you brought that piece up, he said that he was more worried about inflation risks in 2009, 7 months after Lehman, when core PCE inflation was at 0.8% and employment was at 9%. I think we know what the Fed would be doing now in that circumstance. But President Trump made it clear at Davos what he values the most is loyalty, a candidate that says that they will lower rates and stick with that when they get put in the job. I don't know of the candidates who are left who will give him that loyalty.
He wants that loyalty. Kevin Warsh, among others, has known the president for a long time. We know that Trump interviewed Kevin Warsh during his first term to be the Fed chair, ultimately passed on him. Again, this looming question of what is the president looking for in these conversations, which he says have ended now? What's he been homing in on? What's he been talking about? As you say, we're on tenterhooks here, waiting what's going to happen. But, this has gone on for a very long time.
Okay, but last time he said these conversations had ended, we get a story a couple days later, like Rick Reeder coming to Washington, D.C. So I wouldn't discount these talks being over.
No finality yet, yeah.
As for now, these markets headed for another day of losses, undoing the rally that we saw over the past 2 days. You started this week with a sharp sell-off, so even though, yes, the losses aren't too bad today, we're still headed for another weekly loss. That would make it 2 in a row. The dollar, for the most part, has been weakening this week, though getting some life as the euro falls versus the dollar. That's at 117.39. Also getting some relief is your 10-year yield. Those fall by just under 2 basis points at 4.22. And NYMEX crude, that heads higher, as does natural gas, as the East Coast and much of this United States gears up for a wintry weekend. Coming up on the show, Margie Patel of Allspring Global Investments as Wall Street's rally wavers, Duncan Edwards of the British American Business Council as the EU rethinks its relationship with the U.S., and Kay Her of JP Morgan seeing no evidence of a sell America trade. We begin this hour with stocks edging lower ahead of a big week of earnings. Margie Patel of Allspring Global Investments writing, earnings should be good for the fourth quarter, but will it be good enough for investors' nerves about slowing growth? And she joins us now with more. One of the remarkable things, and you point out that the earnings have been strong, so does Bloomberg Intelligence. So far, the beat rate is something like 81%. But Margie, stocks have been punished even so, the worst underperformance for earnings companies going back at least to 2017. What gives for that disconnect?
Well, I think that really there's some nervousness. We've only started earnings season. So far, it's been pretty good. But when you look at the fundamentals of the economy, that's very, very good. The third quarter just reported had GDP growth of 4.4%, which is well above average. And it should actually accelerate at least for the first half of next year because of the benefits of the changes in the tax law that will benefit consumers and businesses. So I think it's nervousness. And I think you're seeing concern about will the tech names, the big tech names that have done so well, continue to have that price earnings erosion, which they've had for the last few months. And that'll really be the keynote is what do they say? I think we may get a surprise. They may once again surprise us with much better numbers than we thought. And that will set the tone, I think, for a market stability and going a bit higher.
How much better can we get than where we are now, Margie, with the huge amount of capex that's committed? What would represent an upside surprise that allows a rally in big cap tech and AI-related names to continue?
Well, I think if they just keep on saying what they've been saying, which is they see extremely strong growth, certainly they've had no trouble with ample cash flow to fund those or to make strategic borrowings, which we've seen from time to time. So I think as long as they don't dramatically shade their outlook, which I think is very unlikely, I think that we should see that confidence come back into the market for those stocks.
Mark, I want to ask you how you're balancing earnings with all the geopolitical risk we've seen. I was looking at Lori Calvasina's note, our friend Lori Calvasina of RBC Capital Markets, writing this morning that earnings season so far has been a bit of a snooze, a bit slow to get going, as geopolitics and other macro matters have dominated the spotlight. Mm-hmm. How do you weigh those two things together? What have you learned over the course of this last week about what's more important here?
Well, I think the strength of the domestic economy is which is most important because we still are one of the growth leaders, even with all the issues that people are concerned about. And I think it's one of the reasons why, frankly, defense stocks have done very, very well because of this concern about what's happening overseas. So we think that that's a great sector, and we think that's really what the market is reflecting. The U.S. economy is strong. Consumers are actually if you exclude the bottom 20%, are actually really pretty much near their highs in terms of wealth and savings. So that's pretty positive.
You mentioned that personal spending. I want to just home in on that a little bit here and ask you how you see the strength of the consumer. Yes, now, but going forward, and the degree to which that's kind of supporting the economy as a whole. We hear that. That's an old trope that the consumer is so important here to the U.S. economy. How is he doing here in 2026?
Well, very, very well, because the consumers, most of them have real estate, which has done very well. They've added to their liquid balances, and they have investments in the stock market, which is another sector that's done very, very well. So except for those who don't have real estate, who don't have an investment in the equity market, everyone else is really at peak liquidity in really all sectors, all segments of the consumer. And actually, if you look, car sales look as if they've accelerated to maybe something like 16 million cars a year. Again, that's a pretty good number. That's a continuing improvement. And my feeling is that consumers don't buy cars if they don't feel good about the future. So that says to me, consumers have backed up all that liquidity by feeling optimistic and buying cars. So we think the outlook for consumers' concern is really way overblown for the actual reality.
Margie, it does feel, though, that the idea of a K-shape, and you're kind of hinting at that, what you're talking about with those that own property and cars, it feels extremely consensus. Day after day, we have people on this program and others who say it is a K-shaped economy, and largely because it is true, but a consensus is always concerning. What is the risk that the K-shape alters? Either the bottom comes up or the top breaks?
Well, I think you'll see a little relief for that bottom 20%. As we continue to see gradual increases in wages and stability in employment. So I think that things have stabilized and will gradually be improving. There's nothing we can do about the very high inflation we've had over the last couple years because of all the spending. That's just passing through the system. We can't do anything about that. We can just hope in the future that we have a little better earnings growth, which I think we will. And yeah, you're right. It's hard to feel that we all want to be contrarians, but really, I have to think that the outlook still looks pretty good for, say, the top 80%, the top 60% of consumers.
And again, you point out that those who own assets are doing really well, and their cohort is growing. There was this Jefferies chart that I saw, Margie, that was really astonishing to me, that retail traders now make up over 20% of trading volume. That is a more dominant force than long only and hedge funds. There's other data out there from JP Morgan and the like just showing that the amount that they've been buying this week and this year that they have been buying the dip. Does that change at all the contours of this market to have a bigger retail presence? And again, it's one we've had before, but it feels, Margie, like it just keeps growing.
Yes. Well, really, it's frankly, you get better returns than if you went to Vegas. So I can see why a lot of people are attracted to the market to so-called play the market. And I think what that does is one, introduce a lot of liquidity, but it also includes a lot of very, very sharp and violent short-term swings in stock prices that we really aren't used to seeing. A company says one little comment and the stock can go up or down 10 or 15%, which is extraordinary. And it really isn't what I would say long-term so-called sophisticated investors. It's more people who are somewhere around day trading or trying to trade off the news. And with trading costs so low, you can see why that's attracted a lot of players who want to get into a market maybe they haven't been into. So I think it's just sort of, frankly, meaningless noise. And when you have these dips because of some temporary bad news that's interpreted, it's a good opportunity if you're basically a long-term investor and you're not bothered by the short-term volatility. But I think just basically meaningless noise, not a sector that knows more about the market than fundamental investors.
We gave glancing mention to small caps last hour. I think we've been marking the records that the Russell 2000's been hitting over the course of the last couple of weeks, and there is this debate: are small caps finally having their moment? And Margie, I wonder what you're seeing when you look at small caps as we make our way here to the heart of earnings season.
Well, I think you're right when you say moment. I think they're having a moment. It'll be short term, and I think the strength of the economy continue to be with the larger companies and have the strength to compete in the U.S. and globally and have the strength to reinvest and hire the best people. So it's a short-term little correction in small caps, but I don't see small caps really leading the market because that's not where the growth really and the strength is in the economy. So I think it's nice to have people make a little money in small caps, but I think larger cap stocks are where the bigger returns are going to be over 2026.
And some of that outperformance this morning with small caps down nearly 0.2%. Margie, so fantastic to have you on. Margie Vitale of Allspring Global Investments. Let's now get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Lizzie Burden. Hey, Lizzie.
Hey, Danny. Intel shares tumbling in the pre-market. The chip maker's first quarter earnings and revenue projections both fell well short of Wall Street estimates. On a conference call with analysts, the company's CEO saying it would take time and resolve to turn the company around. Meanwhile, a US court approving the takeover of bankrupt Roomba maker iRobot by its main Chinese supplier. But creditors and the Chinese buyer Picaya continue to engage with US regulators to finalize the deal. The US government filed a statement this week noting that certain aspects of the transaction may be subject to a national security review. And Apple expanding the job of hardware chief John Ternus to include design work, one of the company's most critical functions. Sources telling us here at Bloomberg that the move solidifies his status as a leading contender to eventually succeed CEO Tim Cook. At 50 years old, Ternus is the youngest member of Apple's executive team. And that's your Bloomberg Brief. Danny.
Lizzie, thank you very much. We'll catch up with you in the next 30 minutes or so. Up next on this show, pushing for peace.
I had a good meeting, but I've had, numerous good meetings with President Zelensky, and it doesn't seem to happen.
We want to stop this war. And that's why I think President Trump he really can, because he has dialogue with Putin.
Ashley Davis of S3 Group joins us next. You're watching Bloomberg TV. Only one more trading day to go until what I think I can speak for us all, and it is a much well-deserved weekend. An exhausting week ending with equities on the back foot after 2 days of gains, after sharp losses to greet the week. We're a little changed this morning, down just about 1/10 or 2/10 if you're looking at the NASDAQ 100. A push and pull between weak Intel earnings and reporting that NVIDIA will be able to sell its H200 chips into some companies for China, at least preps ongoing for that. For the bond market, it's also a calm coming over as we looked at yields breaking into a new range this week, trading around the highest in September. We do get a Fed rate decision next week, and the president continues to tease a new pick for Fed chair. Will we get that, and will that be another disruptor? We're down just over 1 basis point for your 10-year at 422.72. Your 30-year yield trades at 481.72. Under surveillance this morning, pushing for peace.
I had a good meeting, but I've had, numerous good meetings with President Zelensky, and it doesn't seem to happen. Everybody's making concessions to get it done.
We want to stop this war. And that's why I think President Trump he really can, because he has dialogue with Putin. Not everybody has dialogue, just even dialogue.
Here's the latest. U.S., Russia, and Ukraine holding trilateral talks today in the UAE in what officials claim is the first meeting of all three countries since Moscow launched its invasion nearly 4 years ago. Bloomberg's Tyler Kendall and Oliver Crook join us for team coverage on this. Tyler, let me start with you and those comments from Trump saying that a good meeting happened with Zelensky. How much was the dial moved, the needle, in terms of getting somewhere close to reaching agreements that are on their way to ending a war in Ukraine?
Yeah, hey, Danny. Well, ultimately, President Trump did characterize his meeting as, quote, good, but he also said that they didn't necessarily discuss any new topics. Rather, the Ukrainian President Zelensky was underscoring his desire to reach a deal. Now, it is significant, as you mentioned, that we are going into this weekend of trilateral talks on the technical level between the U.S., Russia, and Ukraine, and that really does come after a flurry of diplomatic efforts in recent days. This meeting between Zelensky and President Trump appeared to be a last-minute addition, considering that Zelensky had earlier said that he was unlikely to attend the World Economic Forum. But fresh off that meeting with the U.S., he gave what was considered to be a stunning speech. Our redhead on the Bloomberg terminal read that Zelensky had tore in to European allies over allegations that they haven't done enough to crack down on Russia. He cited, for example, the European sanctions regime against the Kremlin. And Zelensky also brought up this concern that European allies, he said, had been distracted recently over President Trump's recent escalation and then an apparent resolution when it comes to Greenland. So the hope is now that that is apparently off the table for now, in at least some sense, there's going to be this renewed focus, as U.S. officials have repeatedly told us that we are getting close to potentially signing documents that could end the war. We keep hearing them say that we are about 90% of the way there. We know there has been progress made when it comes to U.S.-backed security guarantees for Ukraine, but there are still big questions on the table. One is some more particulars around what that funding is going to look like to rebuild Ukraine, though the EU Commission President Ursula von der Leyen said earlier this week that she was touting this package that is being drawn up alongside the U.S. But Danny and David, the biggest question, the biggest sticking point still remains that potential for territory concessions in the eastern Donbas region of the country.
Oh, let me turn to you. Tyler, bring up Ursula von der Leyen. We heard from her last night. You were burning the midnight oil with all of these European leaders as they had this emergency summit on the heels of that Davos meeting. And it was really principally here to plan a path forward after what had happened when it came to Greenland and the president's threat on Denmark and Greenland's sovereignty here. Just give us the update of what came out of that. I'm curious, there was this conversation about whether that trade deal was going to be codified at that meeting. Did that in fact happen? What was the substance of the talks that unfolded in Brussels over the course of the night?
Yeah, so the sort of main palpable takeaway, the concrete takeaway after EU leaders met here in this building last night until quite late in the evening is that it seems that the European Parliament will in fact move forward now on that trade deal with the United States, which, as you know, was suspended a little bit earlier this week after those threats of tariffs by the Trump administration to these European nations for backing basically dominion by Denmark over Greenland. So that was going to be sort of the main concrete takeaway. I think the other takeaways are kind of the lessons that we now have to sort of appraise after a week of what we saw between the United States and Europe. And I think that there is a degree to which, for many of these European leaders, the damage that has been done over the last week is in some way permanent. It doesn't change the fundamental sort of geopolitical physics between the EU and the United States. The EU and the European countries are completely dependent on the U.S. for a number of different things. But I have to say that the level of trust now has gone to close to zero. So we've been sort of preparing for this moment for the last 12 months. But I think for European leaders, what they got this week for the first time really is that this is not a drill, that basically the United States is ready to weaponize a number of different things that the Europeans, thought was potentially a possibility. This week, they reckoned with what that would actually look like. And for the Europeans, that means how are you going to plot the way forward? And in order to plot an effective way forward, you need to do so with a little bit more backbone, I think, than they have been doing over the last few months. That's sort of a vote in the sort of direction of how Emmanuel Macron has conducted himself, basically drawing a sort of line with the Americans. But the other thing key, David, as ever, and we talk about this all the time, but sincerely true at this moment, is European unity. You have these intra-European dialogues and issues between countries that often sort of prevent things from moving forward at the EU level. You also have a great amount of domestic weakness and fragmentation for some of the biggest players in Europe, such as Germany and France. The question is, will they be able to keep things together in order to push ahead in what is an undoubtedly much more confrontational United States? And I think today, after this sort of week that we've had, the transatlantic relationship has really sustained some permanent damage.
Oliver, Tyler, thank you both for your excellent reporting all throughout this week. Bloomberg's Oliver Crook and Tyler Kendall. Joining us now is Ashley Davis, a partner with S3 Group and a former special assistant in the Department of Homeland Security. Ashley, one of the developments we got in the very early hours of this morning was an idea of a trilateral talk between Ukraine, Russia, and the U.S., supposedly taking place in Dubai for the first time since the invasion. What are your expectations for that?
Well, first of all, good morning. And it has been a wild week. There has been so much that has happened on many different fronts this week. But this is something that I think that the president has been aiming for a long time. Obviously, this is the stickiest issue that he's had. He thought he could end this war, quote, on day one when he came into office. It's been much more difficult. But actually, the three of them, or the three countries sitting down in the UAE, is something that shows me that they're farther along in their process than they have been to this point. Obviously, we've had several meetings with Zelensky. We've had two meetings at least with Putin, and the president has been doing this negotiation kind of in public. And what I've been really watching over the last 6 weeks to 2 months is how he's pulled these negotiations back out of the public eye and really used Jared Kushner and Witkoff to do this silently and then potentially come up with a deal. Also this morning, what came out was the land issue and what concessions will be made. And I think that will continue to be the sticking point. But listen, so many people, thousands and thousands and thousands of people have been dying. I think that everyone in America, Europe, wants this to end, and including the President of the United States.
Something that struck me over the course of the week, and it has been a wild one, as you said, is just the level of frustration that we heard from so many leaders, President Zelensky among them, I think from President Trump as well, with how this process is unfolding. And I wonder, as we hear Steve Witkoff talking to our colleagues saying that they're 90% of the way there, it does seem like that 10% is proving to be extremely difficult. How do they translate that palpable frustration into progress here? How optimistic are you that that's going to happen? You mentioned the land issue. That has been an issue over the course of these 7 meetings that Steve Witkoff has had. I'm just curious of how you see this having been advanced, how much needs to be advanced, and again, how you make that translation between frustration with how long this has dragged on and how little has changed with needing to make some action.
I thought yesterday's speech by Zelensky was very interesting, and I obviously thought that was something that has been talked a lot with President Trump about in regards to the EU. And what Oliver was saying is so true, because the EU is kind of going at this as a group and all the different fractions within the EU. It's so difficult. It's unlike America, where you really have one person that can make the decision of the support. You have all these different countries that have to come together. And what that does is it slows down Europe's and the EU's support. And also, I feel, and can't think of a better word to say, there's so much hand-wringing around what Europe can do because of all that coordination. So I thought that Zelensky's comments were very, very, very important. And also, you have to realize how frustrated the president has been in regards to Europe still relying on all the Russian oil. And they have really not done as many sanctions as Oliver mentioned as well to kind of take that control out of Europe. And so this has been a frustration to the president. I feel, and Europe may not feel this way, that Europe has really looked at the United States to kind of end this war. And I think the president is trying, but there has to be concessions on both sides. Going back to your original question, though, is that I would think, or maybe I'm just hoping, that going to the UAE with a meeting with the three of them has some sort of indication that there'll be progress.
Well, we'll see what comes out of it. Ashley, thank you so much for joining us. That's Ashley Davis of S3 Group. Coming up, British-American business CEO Duncan Edwards as pressure builds on transatlantic trade, plus Vonnie Quinn with your morning movers as Intel sinks off the back of its latest earnings report. Congratulations, you've made it, well, almost to the end of the week. Here's how your equity market is shaping up. Another day of losses after 2 days of gains so far this week. And we entered in a really ugly note, and we are ending lower on the week. I should note that small caps underperforming this morning, down 0.2%. But David, you mentioned this earlier. It has been outperformance. New high, 8 record closes for 2026 so far, outperforming 14 days straight. That is the longest streak of outperformance for small caps in the past 30 years.
Margaret Patel pouring some water on my question about that. But yes, as I say, we've noticed over the course of these last few weeks, movement in the small caps. We can debate sort of the magnitude of that or the importance of it, but it's something I think that we have noted and will continue to note.
I loved Margie's response. She was like, cute for you
yes,
if you've made money here on the small caps, but that ain't
not going to lead the
continue.
market, yeah.
Elsewhere, the bond market is putting up better numbers this morning. You're looking at yields dropping just around 1.5 basis points for your 10-year yield. They had been trending higher, dominated by what's happening in Greenland and Japan. They're at 422.92 this morning. And just quickly want to point out what the yen has done. It's been a wild ride this morning. Dollar yen spikes after a Bank of Japan decision. And all of a sudden, you get some undue strength from the yen. There were chatters of maybe intervention. But David, one thing does stand, that it does feel like Japanese markets have had an outsized role in international markets this week.
Yeah, again, the comments from Ken Griffin of Citadel in Davos talking about the primacy of Japan, what we can learn from what's been happening in the Japanese market and economy, ringing across the world today. And I think that's going to continue.
And Scott Besson also this week saying he had conversations with his counterparts in Japan as well. It is 2 hours away from your cash open. Let's get to your morning movers. With that is Vonnie Quinn. Good morning, Vonnie.
Good morning, Danny. Well, we are seeing a bit of a buy on the news event here for NVIDIA after Bloomberg reported earlier that China officials have told the hyperscalers in China, Tencent, Baidu, ByteDance, that they can start preparing orders for the NVIDIA H200 chip. Now, we had been sort of expecting this, but there was a lot of over and back. So you can see the stock is reacting well today, as are the stocks of its suppliers like TSMC. Now, that is also helping the tape improve, of course, even though futures are pointed lower. So we'll see what happens. There has to be a formal announcement yet from China, but at the moment, those orders can be prepared. And we also know that some of these companies told, for example, NVIDIA, that they were going to order 200,000 of these chips. So that's not a nothing burger for NVIDIA. It's a different story for Intel. It's giving up all its gains of the week. There had been investor enthusiasm before earnings, and we also saw, of course, that $5 billion investment from NVIDIA in the fourth quarter into Intel. The stock plummeting today after Lip Bhutan said there were manufacturing problems in the quarter. Intel just really disappointing investors. Neil Campling of Bloomberg News earlier telling me that, just to put a number on it, Intel is now 1/17th the size of NVIDIA, so it has fallen far, far, far from grace from where it was when it had its biggest position in the semiconductor industry in the United States. It's gone through 3 CEOs in that shape, and we'll see what happens as a result of these earnings. One stock that is, though, improving after earnings is Schlumberger. Well, it's actually down slightly now, but it did beat on the top and bottom lines. It also increased its dividend to 29.5 cents a share. Not quite as much as Bloomberg had projected. But this stock, though, is up 28.5% just year to date. That's just January alone. Of course, some of this is the Venezuela news. It still has a presence there. And if some of the other oil majors do start working again in Venezuela, Schlumberger, or SLB as it's called now, will be called upon for its services. But also the CEO said that some of the 2025 headwinds are now behind the company, and it expects more rigs to be drilling next year in the Middle East in particular. Danny.
Bonnie, thank you very much. We'll catch up with you in the next hour. On our radar this morning, President Trump withdrawing Canada's invitation to the Board of Peace after Prime Minister Mark Carney's speech warning against economic coercion by the world's superpowers. Carney accepting the president's invitation to join the board just last week. Elsewhere, Bank of America and Citigroup are looking into options for a new credit card with a 10% rate as President Trump pushes for a 1-year cap on interest. Offering new cards would be easier for the banks than reworking terms on conditions and existing cards. David, it means we're finally getting a literal Trump card.
A literal Trump card, which Kevin Hassett has talked about, of course. But, you know, you and I get these offers to, have a 0% interest rate for X amount of time. It does feel like we're kind of nibbling around the margins here. Is this doing what the likes of Senator Elizabeth Warren and others have suggested, which is imposing a longer-term, more detailed cap here? We had that conversation just a little while ago about the way that executives are kind of comporting themselves around what the president says. Here, too, another incident of that happening, I think.
Yeah, I mean, maybe Jamie Dimon is going to rethink his kind of call out to, like, why don't you do those cards in Massachusetts or Vermont if you're so bullish on this ability? A real clash with the president over the past couple days.
$5 billion clash.
Very good way to put it. A $5 billion clash. Although I think his pay did increase recently, so maybe he's a little bit, bit more. Yeah, maybe he's a little bit more insulated. Maybe $5 billion is nothing. The other thing on everybody's mind this weekend, at least if you live in the East Coast and the Northeast, is a winter storm. It's expected to deliver heavy snow and ice to more than 150 million people across roughly 24 states. Forecasts predict the storm will plunge Texas into a deep freeze before moving eastward towards New York City and Boston. And a tiny little violin for everyone, including myself, who would plan to travel this weekend. And we'll no longer be doing that.
Looked it up on the old iPhone.
Yes.
14 to 17 inches predicted here in New York. But I, as you know, come from North Carolina, where they're predicting 8 inches of snow, which is crazy. And having grown up there, it will upend things.
But is infrastructure prepared for that, especially in these southern states?
No, and I think there's a sense too there could be an ice storm on top of that. I remember well from my childhood, weeks of no school because there are no trucks or plows to get anything off the roads.
By the way, part of the reason I'm not traveling this week is because I was supposed to be in Vermont, and the expected low is negative 17 degrees. That was worse for me than getting stuff. Hunker down, put on a fire, drink a hot chocolate, maybe something stronger.
Yes.
Especially after this week. Let's get more into that. Turning to trade, the EU is planning to ratify its trade deal with the U.S. after President Trump walked back his threats to impose tariffs on European allies. Bloomberg's Brendan Murray joins us now. Brendan, the feeling is that tensions with Europe once again reached a fever pitch after they had ebbed for the back half of last year. Where do we stand now?
Yeah, it feels like both sides, after a really whiplash sort of week, are walking away feeling like they both came away with a win. You have President Trump going back to Washington saying they're going to give me everything I want on Greenland, although a lot of those details still need to be worked out about sovereignty and territorial integrity. And you have the Europeans saying, look, we threatened to retaliate against the tariffs that he was threatening against us. With a lot of our strongest weaponry. We did it in a unified way, and President Trump ultimately backed down from those tariff threats. So the European leaders met here in Brussels late into the evening last night, and the message that we got from them when they came out looking very tired after a very hectic week was that they can no longer trust the U.S. the way they used to trust the U.S. The transatlantic relationship is going to undergo a rethink, and the Europeans are talking a lot more than they have in the past about strategic autonomy, independence, and trade diversification away from their reliance on the U.S. So the Europeans really feel they got burned this week about that. They've got the war in Ukraine on their eastern flank, and then you've got President Trump on their Arctic flank coming in saying, I want a piece of Greenland. And so they're feeling it from all sides, and they're saying, look, all the platitudes that we've given to strategic autonomy in the past, we've really got to move forward with some actual action on it now.
He just wanted a piece of ice. Brendan, thank you very much. That's Bloomberg's Brendan Murray. Duncan Edwards, the CEO of British American Business, writing, quote, while a positive outcome to end the week, the episode itself has been concerning for business. And Duncan joins us now. Duncan, thank you so much for being here.
Good to be here.
Now, you have a lot of companies that fall under your umbrella, around 500, both here in the U.S. and in the UK. What has been the mood among the members that you've spoken to after the events of this week?
Well, I think, first of all, people are relieved, of course, that there's the additional tariffs that were at least threatened by the president at the start of the week aren't going to happen. Honestly, I think in hindsight, we never really believed that those tariffs were going to happen. I mean, the premise for them was so tenuous, nothing to do with trade at all. So given that the IEEPA tariffs are being challenged anyway through a case in the Supreme Court, this always felt like a real stretch. So When I was talking to media on Monday, I said I didn't think these were going to be introduced, and that's, everyone's relieved that they haven't. I mean, you have to take the threat seriously, but in the end, it was unlikely.
How good are companies getting, or how good are they at dealing with these threats of additional tariffs that, as you point out, are kind of mercurial, maybe not grounded in national security risks? We'll leave that to the Supreme Court to decide what is and what isn't. But we've now been through it. Yes, the first term, now a year of the second. How are executives navigating that particular kind of uncertainty?
Well, I think there's two answers to that question. The first is, I think everyone is now pretty certain that some level of tariffs are going to stay. So business models have been rebuilt to assume that the cost of exporting to the US is now kind of permanently, or at least semi-permanently, higher than it used to be. So business models have been rebuilt around that. The threats of increases on tariffs, there's not really much you can do about that in the short term. People can try and time shipments and things like that. That was never going to be possible in this case. 10 days notice, you can't rearrange shipping. And there has been, I think, a longer-term reevaluation of supply chains. So that part is absolutely real. So there has been some moves to increase manufacturing inside the US. That is real. Maybe not as much as the administration is claiming, but there's definitely some there. So there has been some de-risking of supply chains in order to mitigate what is seen as a potentially longer-term trend to having more protectionist policies, both here and potentially in other blocs like the EU as well.
Prime Minister Mark Carney, I think, gave a lot of professors of political theory an opportunity to stroke their beards, maybe write some books and dissertations about what he had to say in terms of broader geopolitics. On the corporate level, in the private sector, how did what he said resonate, particularly about the role that these middle economies, middle countries can play here, the way that trade relationships and multilateral relationships are going to be kind of redefined or change over the course of these next many years because of what we've seen happen?
Yeah, honestly, I would be guessing to try and answer that on behalf of the executives of corporations. So look, I think there is a reevaluation going on amongst corporations about how they deal with government. And, I think most people are trying to keep their heads down, to be honest. Most business leaders want to get on with business. And I think, you can see the sort of activist approach of this president, which is so unusual. You mentioned the issue with JP Morgan and Jamie Dimon recently. I mean, if you can, keeping your head down seems to be the right approach.
Best not to go to court if you don't have
to.
Yeah, I was going to say, as a member of the media, I, somewhat foolishly think that everybody wants to come on with us and talk about their business and be outspoken. The reticence that you're experiencing of wanting to keep their head down, it was something that Ken Griffin pushed back on this week in speaking with our Eric Schatzker, saying that they should be more vocal, that they need the president's ear. Are any businesses willing to do that? Or is it literally across the board? Everyone you're speaking to is like, I do not want to get involved.
I think the contrast between, in previous years when companies and CEOs have felt they need to contribute to the debate about social issues or cultural issues, completely gone.
Do you think that's a bad or a good turn for business?
My instinct is it's probably a good thing. I think businesses should focus on business. I mean, that's my natural instinct as a kind of former executive. So, and trade associations like us, we have a role to play in that. So our job is to try and represent the views of business on some of these issues. But for us too, we're trying to focus on kind of the business issues rather than the social or cultural issues.
Get us up to speed on where things stand with US-UK trade. I think it's been about 6 or 7 months since I was in Kananaskis watching Keir Starmer there with Donald Trump, as Donald Trump dropped that trade agreement. I put it on Instagram with the Benny Hill theme as they kind of picked up the pieces and put it back together. Where do things stand now? And how would you kind of grade the quality of that relationship? Keir Starmer wasn't front and center, I don't think, at Davos, but certainly was critical of what the president said with his adventurism when it comes to...
Keir didn't go to Davos this year. I would grade it like a sort of B/C. I mean, there was an agreement signed, the so-called economic prosperity deal, back in May, which set the tariffs, the 10% baseline tariffs. But in that agreement, which was effectively an MOU, a heads of terms, rather than a properly papered document, it set out a lot of kind of future negotiations that were intended to happen. And quite broad-ranging and potentially ambiguous statements in that document. And since then, both sides have been trying to turn that MOU into a proper legal treaty. And it's been very difficult because the expectations around what that actually meant, what that implied, are quite different. So from the US side, I think there was an expectation that there would be a wholesale change of attitude towards some areas of UK policy around standards, food and agricultural product imports, data issues, the relationship with the EU, a whole range of things. Whereas I think from the UK side thought, no, this is just a sort of, we'll tweak things, but there's no kind of wholesale readjustment. And so that's led to, frankly, an impasse. So there was then a technology prosperity deal, which was again a very 2-page MOU. When the president was in Chequers, which again hasn't been negotiated properly. And then finally there's a pharma deal which was announced before Christmas, which looked extremely promising. But again, we haven't seen the details of this agreement. We've seen 2 contrasting press announcements from each side, which almost describe 2 different deals. Yeah. So I think there's a bit of frustration on both sides. On a practical level, kind of business is just getting on with it. Yeah. So, trade and investment continues to happen.
Duncan, thank you so much for your time this morning. Yeah. I hope you are able to hunker down and stay warm this weekend.
I'm meant to be flying to London on Monday at 8:30 in the morning. So
you will be in our thoughts this weekend, Duncan. Good luck to you. Yeah, we'll see you on Monday, I have a feeling. Duncan Edwards of the British American Business, thank you so much. Let's get you an update on stories elsewhere this morning. Here with your Bloomberg Brief is Lizzie Burden. Hey, Lizzie.
Hey, Danny. Elon Musk's SpaceX has lined up 4 banks to lead its IPO as it moves forward with plans for the biggest listing ever. Sources telling us here at Bloomberg the company sees Bank of America, Goldman Sachs, JP Morgan and Morgan Stanley in senior roles, although no final decisions have been made. SpaceX is targeting an IPO as soon as this year that would value the company at about $1.5 trillion. Elsewhere, Lululemon's Get Low leggings are back for sale despite being see-through. With fresh disclaimers, customers are being told to size up and pair the leggings with skin-tone seamless underwear. This after the founder Chip Wilson derided the board, saying it was a, quote, total operational failure. And finally, JP Morgan Chase CEO Jamie Dimon earned $43 million last year. According to a regulatory filing, Dimon's total compensation increased 10% in 2025. He received a base salary of $1.5 million and $41.5 million in incentives. Dimon is one of the highest paid bosses in corporate America. And that's your Bloomberg Brief. Danny.
Lizzie, thank you so much. Up next, not sold on the Sell America trade.
The US has been really an incredibly strongly performing market, strong economy. Reallocating away from the US in the face of that, probably not the smartest choice to make.
Kay Herr of JP Morgan Asset Management will be joining us next. You're watching Bloomberg Surveillance. Under surveillance this morning, not sold on the Sell America trade.
The US has been really an incredibly strongly performing market, strong economy. People have been predicting the US to be at some type of decline from an economic point of view, recession. None of that's actually happened. The US bond market is still the most liquid market in the world, and it is still the closest thing to a risk-free asset that there actually is. Reallocating away from the US in the face of that, probably not the smartest choice to make.
Here's the latest economic data showing resilience in the U.S., reinforcing trader expectations that the Fed will delay cutting interest rates on Wednesday's meeting. Joining us now is Kay Herr of JP Morgan Asset Management. Kay, there was a serious rupture, at least to start the week. I mean, okay, rupture might be extreme, but we were in such
to borrow a phrase from Mark Carney, I guess.
Yeah, it wasn't a transition. It was a rupture. Actually, was it a transition or was it a rupture that we saw this week in the bond market?
Wow, I don't even know how to answer that, Danny. So I started Tuesday morning thinking we were going to have a pretty quiet week, not a lot of economic data, most people in Davos. Same for you all. I'm thinking it's going to be a quiet week, and it hasn't even ended up that way. Here we are Friday. Markets seem to have settled down, and I'm delighted to be here. But you've got an interesting, I'm going to say eclectic group of people
well
on
said.
this morning.
Yes.
You're talking trade. We've got a meteorologist
Lizard
on at
Trade.
8:15.
Yes.
I'm pretty excited about that.
Kate, you're hired to be our promoter. I love
okay,
this.
sure. I'm happy to do that. So I think we've got to take a step back. Markets focus on fundamentals, and we don't have a lot of major fundamentals. Sure, we had GDP in at 4.4% yesterday, but we don't have a lot of fundamentals right now until the next employment report comes out on February 6th. So we've got 2 weeks, not a lot going on. And we all know that volatility, both in equity and in fixed income markets, has been relatively low. So you get some, I don't think any of us expected to be thinking about Leif Erikson and Eric the Red this week. And I think those types of moves make people stop and say, whoa, what's going on this week? So I don't think it was a rupture. I think it was a reminder that when valuations are full and unexpected events and news come in, everybody takes a pause and reassesses.
Let me pull a strand from Davos, and I know your remit is the U.S., but I want to ask about treasuries, because we had this Danish pension fund offloading a lot of treasuries, and they said, it's just part of normal course of action here. You had Scott Bessent, the Treasury Secretary, being pretty blasé about that. Who cares if Denmark does this? You heard something very different from the president, who was very upset about the prospect of the European private sector retaliating against the U.S. How do you view that, the chance that this could all backfire and have ramifications on the U.S. Treasury market?
So look, I think really to Danny's point, what's reemerged this week or for part of this week is the Sell America trade back on. And the Danish pension treasury comment is really a subset of that. And that's obviously unnerving to the markets. But I think we've got to take a step back and look at what the fundamentals are in the market. And let's look, for example, at the U.S. investment grade. Actually, two things. First off, we had a 20-year U.S. Treasury auction this week. The 20-year is not the kind of most popular.
We're not citing
There's
it
not
day
a lot
in, day
of.
out.
No, exactly. You just proved my point. And yet, end user demand in the 20-year auction was, I think, record strength. So my second data point to say Sell America is really not in force this week is look at the IG market. So we've had $170 billion of issuance in the U.S. investment grade market year to date. And what have spreads done in the U.S. investment grade market? They tightened and hit a record since, I think, 1998 yesterday at 72 basis points over. So you hear a lot of rhetoric about Sell America, but when you look at the facts and what's going on in markets, we're seeing strong flows into U.S. fixed income markets, and we're seeing strength across investment grade and treasury auctions. So we'll have another opportunity to look at this next week. We've got 2, 5, 7-year note auctions next week, and we continue to look at that, but we see no evidence of it so far.
Okay, only about a minute here, but also reflecting on the past week, a lot of the bond market moves was attributed to geopolitics. How much of it was just about Japan and just about the rise in JGB yields?
I think that's a great point, and I think it really was. I think if you look broadly, global bond markets are very correlated. And so if one market, maybe to quote the president, if one market gets the yips, then I think it's natural for other markets to get the yips. And I think when you look at the 10-year Treasury, the 10-year Treasury has been sitting between 3.75 and 4.25 for months and months and months. And it's just sat in this night range. You get a little bit hotter inflation number, and it hits to the high end of the range. You get a cooler employment number. We head to the weaker end of the range. We're sitting there. We've been testing that 420. We breached the 423 level, which is a 200-day moving average. And then you get the yips from the Japanese market, and everybody gets a little unsettled, and you throw in a Danish pension, and you get that. I think what's happened towards the end of the week is we're settling down toward, okay, actually we're in a low hire, low fire market until we get evidence that across corporate America, you see strength in earnings. So until we get some evidence that we've got some substantial weakening in the employment market or some reacceleration in inflation, I think yields are pretty attractive here.
Okay, thank you so much.
Do you want to stay for the weather segment?
I'm going to watch it on my own terminal. I'm going to head back to the office. But
it
thank
goes,
you.
in importance, it goes Kay and then our meteorologist.
Meteorologist above me.
U.S. markets are the deepest and most liquid markets.
We still see a lot of upside opportunity in U.S. markets.
I don't think we'll see a massive correction.
The U.S. has been really an incredibly strongly performing market.
We continue to be positive on the U.S.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good Friday morning. Only one more trading day until what's expected to be a very wintry weekend here in New York City. And for a lot of you out there, U.S. stocks set to close out their first back-to-back weekly loss since the summer. The tech underperformance also dragging on as the Mag 7 turns into the Lag 7. Please forgive me for that one. Adding to the pain this morning, Intel earnings as the stock's spectacular run hits a roadblock. Over the past year, up 150%. Post-earnings down 13% in the pre-market.
I mean, just fascinating to continue to watch this stock and look at its history. We've talked about that over the course of the morning. Vonnie bringing it up as well. This used to be a behemoth inside everything, famously, and really having a difficult time getting its footings. We've seen NVIDIA kind of surge and overpower it here. Look, it has new leadership. I think it can still declare that. This new CEO can declare that, but really having a difficulty here in terms of manufacturing, meeting demand, and trying to figure out, as I asked about, sort of what this company is exactly going for.
And I loved that question. And it's also a company that now has the backing of the government. This just shows that backing and extra monetary firepower does not guarantee good results. But it also speaks to this moment we're in, where so many stocks have run up and there's a lot of assumptions baked in, and those feel increasingly fragile.
Absolutely. But getting back to what you said, I think that the conversation surrounding the U.S. taking a stake was what will that mean for this company's competitiveness, its ability to compete? I think for those who were raising that concern, they have a lot of grist here for that argument.
And there's a lot more questions being asked about what is U.S. involvement in general in corporate America mean. For this market, though, it is concentrated on those losses from Intel, but getting a little bit of a boost from NVIDIA outperforming this morning. Our reporters suggesting that China is allowing at least some companies to prepare to order H200 chips. You're looking at an S&P future session down only 0.1%. The euro weakens after it had been strengthening against the dollar for most of the week. You're also looking at a 10-year yield batting off some of the weakness of yesterday. Yes, we've broken above 423. We were just talking to Kay Her about this at the Sell America trade. Maybe don't buy on that one. And NYMEX crude, that's up by 1.9% this morning. Coming up in the next hour, Savita Subramanian of Bank of America Securities as stocks are edging lower. Aaron McLaughlin of the Conference Board with big banks weighing President Trump's cap on credit card rates. And Fiona Senkata of Forex.com looking ahead to next week's Fed meeting. We begin this hour with stocks edging lower, closing out a volatile week on Wall Street. Savita Subramanian of Bank of America Securities expecting the S&P 500 to end the year at 7,100, writing our economists above consensus GDP forecasts and our above consensus earnings forecasts are more consistent with middling equity returns. Thus, we have a target for the S&P 500 that is lower than most. And Savita joins us now. Savita, this is a wonderful view because it is both bullish and cautious at the same time. Where does that cautiousness
it's kind of hedging, isn't it? Well, look, I'm not necessarily bearish on the equities, but I do think that expectations right now are much higher than they've been over the last 3 years of double-digit aggressive gains in the market. So here's the deal. The market usually has its best performance coming out of these disaster-averted scenarios where you think everything is going wrong and then you get a sigh of relief or some kind of a break. Think 2009, even, post-COVID. So I think that where we are right now is a market that has a lot of expectations baked in. The multiples are high. We've got, a lot of tech companies that used to be asset light and innovators now becoming more clunky and asset intensive. Our view is earnings are going to be great. The economy is going to be great, but you're going to see significant multiple compression. And this is actually right in line with history. If you look back over time and you look at years with above trend earnings growth and above trend GDP growth, those have actually been the worst years for equities based on average return. So it's not necessarily, the market doesn't react to what's happening, it anticipates what's going to happen. And I think that's where we are now, is a market that's already anticipated the good stuff that's about to happen.
It's such a good point, because not only are valuations rich, but all the data of ownership of this equity market feels really stretched too. I know your team in the latest fund manager survey put out that hedges just don't exist right now for equities and equity correlated assets. To what degree does that in itself just represent a risk for this market?
Yeah, I think that is a risk. And in fact, I think what's even more risky is that a lot of previously uncorrelated asset classes have grown more correlated in this liquidity injection that we saw in 2025. So here's the other kind of risk is going forward, we're kind of as good as it gets when it comes to liquidity. The Fed has been cutting, profits have been accelerating, we've got the government buying stocks, we've got individual investors buying stocks. Everybody's buying stocks. And now we're starting to see maybe a less good backdrop. So you've got tax receipts probably going to be healthy, but everybody's talking about that. Nobody is talking about the fact that capital gains on short-term trading are probably going to be a big draw on a lot of investors' wallets. So I think there's puts and takes for everything, but the fact that everyone's talking about the good stuff and not the bad stuff makes me worried about the next 12 months.
Larry Fink at Davos saying he doesn't just believe we're not in a bubble. He sincerely believes we're not in a bubble. And you've talked about there being an AI air pocket.
Air pocket,
so
yeah.
not as frothy, perhaps, as a bubble might be.
Yeah.
Explain what you mean by that. And I think this is an earnings season when, in light of what's happened over the last few months, there are people who are wanting to see kind of proof in the pudding, want there to be kind of measurable examples of how this is playing out or likely to. Yeah. By when do we need to see something manifest in AI actually leading to gains in this economy market?
No, exactly. And I think we're comfortable with the idea that this is going to take a while, right? It's not easy to get all that power set up to run all these chips. But the problem is when you look at these companies, a year ago, they were spending their own cash on capex. Now they're being forced to go to capital markets, raise debt. And that does a couple of things. It increases their cost of capital, it increases their interest rate sensitivity, and it also just suggests that we're further along, and if sales don't keep up with this capex, they're going to have to borrow more. It's starting to look a little bit like the telecom crisis of the late 90s, where these were highly levered companies. Today's tech is much cleaner, much more healthy. But the direction of travel right now just feels less good rather than better. So I think that a lot of the reasons that we liked, the S&P 500, that we liked tech, are starting to reverse. And, there are other sectors that look much more interesting.
I remember a couple of years back talking to Michael Hartnett, your colleague, about the Magnificent Seven. He coined the term.
Yes.
And we talked then about the need for things to broaden out.
Yep.
Here we are, again, years later, having this same conversation.
No broadening, I know,
And so what is your sense of when that's likely to happen? What would catalyze that happening? Are we seeing any indications that that's in the offing?
So I think it happens now. And I said that last year and I was wrong. Why was I wrong? I think part of the reason was April 2nd, we had this sort of curveball around policy, which created a bit of paralysis in corporate America. Today, think about what's happened. We have this one big, beautiful bill act, which incorporates bonus depreciation. That means that if you spend on capex now, you get to, you get kind of a free pass on it. So I think that what that means is when you listen to companies talking about this, energy companies, real estate, materials, manufacturing companies are talking about bonus depreciation and how that might pull forward capital spending, which is actually pretty good for the economy. It's good for consumers. It kind of, keeps everything going. It's the animal spirits argument and the missing link in the economy over the last, 20 years. We haven't made stuff in America in a really long time. So I think that's one big change that could drive broadening. The other critical data point that we pay attention to is guidance. Mm-hmm. Last year, CEOs aggressively guided above what analysts were expecting. These guys have every reason to lowball estimates and beat those estimates. That's how they get paid. But they're telling us they're going to do better than we think. So chances are they're still being conservative. But I think that's the argument for broadening. The number of companies that have guided up versus down over the last 3 months, 2 to 1. Wow. Normally, it's the opposite. Oh. So I think it's a really interesting time, and there's some proof of broadening actually starting to happen.
If we were to put some detail around that, how much of the broadening is the 493 versus mid cap and small cap?
Yeah, so we're looking at the S&P. 2 to 1 means that twice as many companies in the S&P 500 are guiding above. So it's across the board. You can't fake this with 7 companies crushing it. I think that's what's important is it's a breadth ratio. A lot of the breadth ratios we look at are pretty healthy now. And I think analysts are starting to pencil in better growth. So, this is all good, but we haven't necessarily seen the market react to that earnings story. I think what's also interesting is companies that are surprising on earnings, especially in these like well-held sectors like tech, aren't necessarily rallying. In fact, some of them are selling off. So, that's another sign that positioning is very crowded and very kind of aggregated in this one pocket of the market, secular growth stocks, AI, themes, whereas the cyclicals and the companies that could actually benefit from a capex cycle are relatively unloved and cheaper.
What are those specific sectors you're looking at to lead that rally?
So I think that, in prior manufacturing capex pickups, you've seen materials, energy, industrials, financials do well. I think in this cycle, you've also got healthcare, which is a sector that we think of as defensive, but it could actually do pretty well from AI adoption. This is the one sector where we're really seeing clear use cases in AI. These companies are starting to use it. It's a very inefficient, labor-intensive sector that's starting to clean up its act. Same story for financials to a lesser degree. And then I think that, in the consumer space, what I worry about is discretionary spending. So I think we could be in a year or 2 or 3 where manufacturing takes the reins, but consumption kind of falls back a little bit. And think about the U.S. consumer. The biggest driver of U.S. consumption growth over the last 30 years has been white-collar professional services employees, 25 to 45 years old, getting jobs on Wall Street, in tech, et cetera. Those jobs are kind of grinding to a halt. So I worry about that consumption growth engine maybe tapering off for a little bit.
Let me bring that back to what you said about the one big beautiful bill, because yes, it has that capex facet to it too, but I think there's also this belief that when it's all put into effect, it's going to be demonstrably better for a lot of Americans. They're going to have more cash. It's going to kind of free up the consumer more than they've been under. How do you feel about that, and how does that manifest itself?
Affordability is a buzzword. And look, I think that's going to be really good in terms of equalizing the playing field. So where we see the benefits from tax reform and a lot of the stimulus that we're hearing about is really in that lower income cohort that has been struggling. This is one reason that we're bullish on consumer staples. Consumer staples is much more geared to lower income consumption, lower price point retailers. And that's the area of the economy that has been struggling. And you've seen staples underperform for years now. I think that's one area that could see a lift from, just checks from the government, no taxes on tips and overtime. I think those are all beneficial to that lower income services cohort that has been the area of struggle.
I'm going to go to a question I've asked a couple times this morning, a variation on it, and that is, when the president's speaking, are you now adept at kind of turning that down? Are you closing Twitter and social media? How much are you looking at earnings exclusive of what we're seeing in terms of kind of broader geopolitical risk? How much does that matter as you think about things holistically?
No, it's such a good question. And normally we really didn't pay that much attention to politics and policy, but now I think it is more important. And I think we're at an interesting moment where, we're seeing a lot of big shifts. We're seeing a move from disinflation to potential inflation, maybe even a big upside surprise in inflation. We're moving from an environment where the way to make money was to move your stuff to cheaper parts of the world or source from cheaper parts of the world. Now companies have to be efficient. They're focusing on productivity. I think this is good for corporates because they're doing the hard work of managing risk in a much more high quality way, an operational change way, rather than just global cost arbitrage or share buybacks. Mm-hmm. But I think it's going to be different. It's going to be different leadership. Again, we've spent 20 years or more underinvesting in manufacturing in the United States, right? We're not ready to make stuff aggressively. So I think we need to see that transition. Infrastructure spending, bolstering the U.S. infrastructure in order to be able to manufacture. So those are some of the themes that I think could be surprises over the next 5 years. But I do think we have to pay more attention to policy. It's a very interesting moment.
The world we live in now, yeah.
Savita, thank you for helping us navigate that very complicated world we live in. Always great to see you. Savita Subramanian of Bank of America Securities. Let's get you an update on stories elsewhere this morning. Here with your Bloomberg Brief is Lizzie Burden. Hey, Lizzie.
Hey, Danny. President Donald Trump continuing to push for access to Greenland. Sources telling us here at Bloomberg the US wants to rewrite its defense agreement with Denmark to remove any limits on its military presence on the island. The current arrangement, signed in 1951 and amended in 2004, calls for the US to consult with both Denmark and Greenland before it makes any significant changes. Elsewhere, Texas Governor Greg Abbott issuing disaster declarations for more than half the counties in the state ahead of a powerful winter storm. The storm is expected to be one of the toughest tests of the electric grid since a deadly 2021 collapse. The storm could encrust trees and power lines with ice, leading to widespread outages. Estimated damages and losses may reach $25 billion. And Tesla CEO Elon Musk says the company is preparing for the commercial release soon of its Optimus robots. Speaking in Davos, Musk said the company was already using some of the robots for simple tasks in its factory. He also predicted that Optimus would be doing more complex tasks by the end of 2026. That's your Bloomberg Brief. Danny.
Hello, robot overlords. Lizzie, thank you very much. Up next, the morning calls plus Bill Waddell of AccuWeather on what to expect from the looming winter storm. That's coming up. You're watching Bloomberg Surveillance.
We were bullish about server overall demand, CPU demand, and I think they reiterated that message. But I think what was disappointing was the guidance. They are still having some of their own production issue, execution issues. They've also maybe hampered by ongoing component issues, such as memory prices have continued to go up. The positive part is that demand is good, but they haven't been able to deliver so far on the execution.
Frankly, there of HSBC on Intel. Speaking of which, let's get more on your morning calls. First up, Citi has lowered its price target on Intel as the firm believes the tech giant's gross margins could remain under pressure. Next up, Barclays raised its price target on Tesla to $360 a share. The firm says Tesla is benefiting from healthy production rates and reduced electric vehicle losses. And finally, Goldman Sachs upgrades Spotify to buy, saying that they see the streaming giant well positioned to capitalize on rising generative AI adoption. Turning now to weather, more than 175 million people across the U.S. will be impacted by a massive winter storm set to sweep through dozens of states. AccuWeather's Bill Waddell joins us now with the latest on the forecast. Bill, good to see you. Hope you're staying warm. How is this storm shaping up?
Good morning. AccuWeather meteorologists say this is the winter storm that will shut it all down. We're joining you from Charlotte, North Carolina this morning, where we're expecting a coating to an inch of ice starting Saturday afternoon, and then half an inch to an inch of ice after that through the weekend on Sunday. This is going to be an absolute mess. As you said, the impacts are going to be spanning more than 2,000 miles. We're talking about New Mexico and Texas, all the way up to the Carolinas, with the significant and severe icing impacts. Freezing rain here is a huge concern. When we have those accretions of ice on power lines and trees, it can quickly add hundreds of pounds of weight, bringing them down. And our team is concerned about extended power outages that could leave people without electricity and heat for days, if not a week or longer in some areas. Now, let's talk about the northern side of this winter storm. Just some incredible snow totals are being forecasted. More than 2 feet in some areas of the Appalachians and the Mid-Atlantic. Of course, big cities along the Interstate 95 corridor, we're talking well over 6 inches. New York City, Philadelphia, Boston, throughout this corridor. Major impacts Sunday. AccuWeather meteorologists telling us now they expect up to 9,000 U.S. flight cancellations Saturday, Sunday, into Monday. So this is going to be a massive travel nightmare for people, for businesses, a lot of supply chain logistics, deliveries. Of course, you think of the cities in that snow and ice zone. We're talking Dallas, Louisville, all over. Big commerce impacts expected over the next few days. But this could quickly escalate into a life-threatening situation, especially on the southern end of the storm, where we're dealing with all of the ice and the potential for people that could be without heat and power for several days in sub-freezing temperatures.
Bill, let's hope everyone is as prepared as they can be. Thank you so much for that, Bill Waddell of AccuWeather. Now, meanwhile, as we look at that forecast coming, natural gas futures are coming back down today, but it followed a record-breaking 3-day rally as that freezing weather sweeps across markets. Bloomberg's Simon Casey joins us now for more. Simon, how much of this is about the weather versus just positioning being offsides to this move?
It's all about the weather. The natural gas market in this country largely moves on the weather, so week to week, day to day. And what we saw, well, first of all, we had a long weekend last weekend. And as you remember, the forecasts emerging over the weekend were increasingly concerning. So you had this sort of 3-day gap between trading sessions. And then since Tuesday, the price has gone, it's rocketed higher, almost up. I think when I last looked at more than 70% up for the week. It's a pretty historic move in that market.
Bill giving us the brief there on what the forecast looks like, and it sounds like an historic storm in many parts of this country. What does history tell us about sort of the effect this is likely to have on the market going forward?
I mean, for the natural gas market, things probably will settle down. The price action that we've been seeing is what we call the front month futures contract. So for delivery through into February, further out prices are not nearly as elevated. So this is kind of a sort of a short-term anomaly, but it does speak to the anxiety that's out there. And memories are still very fresh. 4 years ago, the winter storm that hit Texas, we saw massive disruption both in natural gas and electricity markets, and that continues to reverberate to this day.
Glad you bring that up. I think we all remember that, and I know that what's changed a lot since then is just the kind of population of data centers that we have all across this country. How has that variable changed the way that we should look at all this?
We're going to find out, I think. I mean, to a certain extent that affects Texas. Texas also has had a very strong economy since that time. The population has grown, the demand has grown. The state has gone some way to addressing some of the problems that were made apparent back in 2021. They've winterized, they've solidified the grid. It's probably more resistant, a lot more resistant than it was, a lot more solid. But the data centers, the boom in data center construction, what we've seen is predominantly that's been focused around Virginia, in the PJM grid, which covers that part of the country further over to the east. Now, the weather is going to affect that part of the country as well. And only last week we saw an event in the White House, I think it was last Friday, where it was addressing concerns about affordability on power, but also there is a projected shortfall. Now, there is enough power for the moment, but that's getting stretched pretty thin. So we'll find out over the weekend how robust things really are.
Yeah.
What is the bar to see that domestic disruption? How, as you said, Texas may be a bit more fortified, but how fortified? What does it take to really upset this domestic market?
Key thing is going to be ice accumulation on power lines. Do power lines fall over? And then are there knock-on effects as power is rerouted to meet sort of shortfalls and outages, and whether there's a domino effect? That's what we saw 4 years ago. The latest forecast for Monday, when people go back to work, and in Texas, we're forecasting record power demand for this time of year. There should be more than enough power online. Now, the question is, are there any power lines and infrastructure that gets knocked out, and does that eat into that surplus of power? So it's going to be critical to see to what extent the infrastructure gets damaged over the weekend. What we're expecting is temperatures are going to be very, very low. There will be ice, but it's going to be a shorter duration event than what we saw in 2021. So fingers crossed, hopefully it won't be quite as bad.
I was going to say, I think a lot of people hoping we don't see the worst of this storm that's predicted. Simon, thank you so much for joining us. Bloomberg's Simon Casey. Coming up, Aaron McLaughlin of the Conference Board as big banks weigh President Trump's cap on credit card rates, plus Bonnie Quinn, your morning movers as Nvidia rises higher as China greenlights H200 orders. Moving closer to the last equity trading day of the week. Thank goodness. Yes, it's only been 4 days, but it does not feel like that. We are looking at some of the worst of the losses this morning, only down 0.2%, though, I should say. Intel is weighing heavy on this index this morning. The euro starts to fall, snapping some of the dollar's losing streak. Your 10-year yield, that standing at 423.11 this morning, down by about a basis point. That's also a break of a trend of higher yields, be it because of geopolitical concerns or what's happening in Japan. Some serious moves in the Japanese currency market this morning. NYMEX crude, that's also higher with most of this energy market as the U.S. Northeast and Texas eye some pretty serious disruptive weather. We are 1 hour away from the cash open. Here with your morning movers is Vonnie Quinn. Hey, Vonnie.
Hey, Danny, you're right. Intel weighing on this market. We're back down to session lows, and we could be on for back-to-back weeks of declines. But bear in mind, we are still up year-to-date 1% for both the S&P and the Nasdaq 100. Nvidia should help today, although we are pairing our gains right now. A little bit of buying on the news in the pre-market. We got word at Bloomberg that some Chinese officials had told some of the Chinese hyperscalers, so Tencent, Baidu, Alibaba, that they could start prepping orders for H200 chips. Now, this is tantamount to official formal declaration that China can import Nvidia chips, right? Which we sort of knew was coming, but we needed some more formal underscoring of that. And so you can see the suppliers to Nvidia are also rising. Booz Allen Hamilton, this is an interesting one because this is an example of the rotation trade, right? This is a Russell 3000 company, a defense contractor. It's up 13% year to date. It beat estimates and raised its guidance up 5.5%, but it is still down 30% year over year. So if you're looking for an example of where the rotation trade is happening, it's potentially in these defense contractors. We know that President Trump wants a ramp for defense spending in the coming years, a phenomenal ramp, and that would benefit the likes of Booz Allen Hamilton. And then let's take a look at the solar stocks, because of course we had Elon Musk making comments in Davos this week to the effect that within a few years SpaceX is going to be putting solar-powered AI panels into space, and that would definitely help with the energy crisis that many say we're about to see thanks to these data centers that are just eating energy. President Trump wants each to have energy associated with it. Array Technologies up 2%, First Solar up more than 1%. And given President Trump's position on solar technology, you wouldn't think these stocks would be higher, but they're actually up more than 35% for solar and more than 50% year over year for Array Technologies. So it's an interesting sector to watch, Danny.
Bonnie, thank you very much for your work this morning. Turning to the consumer, Bank of America and Citigroup are looking into options for a new credit card with a 10% rate as President Trump pushes for a one-year cap on the interest rates. Joining us now is Bloomberg Intelligence's Herman Chan. Herman, what might we get from these banks when it comes to new cards?
Right. So things seem to be pretty fluid right now, but our Bloomberg News colleagues did have some reporting on a potential new card that has the 10% rate cap from both Bank of America and Citi. We think that could have some modest uptake because really that card offering would be more limited to your prime, super prime cohort that really doesn't carry a balance typically. So it still remains to be seen how it's going to be rolled out, but that's what we know as of now.
Herman, in evaluating these companies, is it your assumption that this takes the regulatory heat, or at least the heat from the president, off of them?
Right. So we view any potential rollout with a 10% rate cap as a PR win for the administration, and it really would reduce some of the overhang for the card issuing banks that we cover. Since that tweet that came out, let's say 10, 14 days ago, the bank stocks are down for our coverage about 5 to 8%. So it has weighed on some of the sentiment. So potentially that could unlock.
I want to ask you just about the potential impact of a broader cap here. I remember what Jane Fraser of Citi said shortly after this was announced via that tweet that you mentioned, that there were studies that would indicate that this would have a huge impact on many Americans' ability to get credit in this country. Is there that corpus of literature? Have there been studies of this? And sort of as you've gamed this out, what would it mean if we saw, yes, that broad cap put in place, and sort of, again, if we move to this latest announcement about this potential card with a 10% rate, what would that mean for the bottom line of these companies, for these big banks?
Yeah, so the banks just wrapped up 4Q earnings season, and collectively they were very dismissive of any potential issue because it would just be devastating for the American consumer. It would really cut off credit for a large swath of Americans and bank customers. I harken back to what we see from the annual stress test for the banks. And the Federal Reserve bakes in a 17% loss rate for credit cards under an adverse scenario. So we're talking about, if rates are capped at 10%, would be grossly unprofitable for the entire industry under that sort of scenario. So banks need to plan and prepare for that sort of thing, and a 10% rate cut would be very unproductive.
Herman, thank you very much for that. Herman Chan of Bloomberg Intelligence. Sticking with the consumer, Aaron McLaughlin of the Conference Board joins us now. Aaron, great to see you this morning. I have to say, these big banks, the CEOs, they've reiterated, even if they don't agree with the 10% cap, they've said, yes, we agree with the president. There is an affordability issue. Are moves like this to offer some credit cards with a 10% cap, does that move the needle at all with making American consumers feel better about affordability?
Well, I really don't know that it does. So I looked up some data points, and we know that about 60% of Americans carry credit card debt, and about half of those carry it for more than a year. So that is a persistent structural issue where they're not able to meet their bills and they're relying on credit to help pay for things. We've also seen, for example, housing, which is such a big topic, which is the biggest expense for most consumers. The cost of housing has doubled in the last 5 or 6 years. And so, offering new credit cards with 10% to prime or super prime borrowers, those folks are probably not the ones carrying credit card debt. Might be a message win, but I'm not sure it would really make any difference for the American consumer.
Aaron, there does feel this weird contrast where the affordability concerns are real and many people are facing higher costs, as you mentioned, in housing across the board, yet we continue to get spending data that shows a really robust consumer. How do you square the two?
Well, I think it comes down to the labor market in large part. A lot of consumers feel, they are continuing to spend as long as they have jobs. And credit card debt is a good indication. Back in 2022, of course, this was coming out of the pandemic. People were not traveling. They maybe weren't eating out as much. Credit card debt hovered around $800 billion. Now it's up to $1.2, $1.3 trillion. And so some of that is probably interest rates on the credit cards going up. But some of that is consumers, I hate to say it, but getting DoorDash, being out and sort of living their best lives post-pandemic. And I think that when we look back at these, at the 20s, at this moment in history, we will see that consumer behavior, really was a result of different sort of points in time, such as the pandemic.
Next time I get takeout, I'm going to say I'm living my best life.
You're living your best life. A good of reason is
delivery, not takeout. Excuse me. Aaron, let me move to another plan or concept of a plan we've seen floated by this administration. That is through this executive order on housing, that there's going to be a prohibition here on big companies owning a significant chunk of housing properties. Yes. As you think through what Danny brought up, this affordability question, does that make any noticeable difference in sort of how Americans deal with this affordability issue or crisis? Is it going to make a difference in their daily lives if we're having these companies unable to purchase homes in the way in which they have?
Well, we are writing a paper about it right now. It's coming out later this week at the Conference Board, and it's really, really interesting. So we did not have large corporate investment-owned housing before the Great Recession. Companies just did not go in and buy single-family homes. It was not a business model at any large scale. It has really, really developed in the last 10 or 15 years, but it still represents less than 1% of single-family home purchasing and then therefore renting out on a national basis. So on a national basis, it will have very little impact on affordability. It won't really move, the supply needle that much. It won't really move the price needle that much. But there are some markets, and they're all in the Sun Belt for the most part, where there's been a really heavy concentration. So if you limit future purchases in those markets, because I'm not sure, although the executive order does possibly refer to, looking into sort of competitive issues. So I guess there is a potential that companies might have to sell some of their portfolio if it's anti-competitive in certain markets. But, looking forward, it might create some affordability, might benefit some consumers in some Sunbelt cities like Atlanta and Tampa and Phoenix, where we've seen a heavy purchasing of these kinds of properties. But overall, it will have really, really a minimal impact on housing affordability.
So here's my overarching question about consumer sentiment. You study it so closely. Does the sense that policymakers are doing something lead to an uptick in consumer sentiment, or does nothing really compare to a difference in the bottom line? I think of the president floating these $2,000 tariff checks. Should that come to fruition, I imagine that would lead to an immediate boost in consumer sentiment. Does all of this stuff that's happening on the margins, the promise of these changes to housing, to credit cards, lead to a boost in consumer sentiment as well? Or do consumers, I think, rightly understand that it's stuff that's like not fully fleshed out and not likely to impact them immediately, if at all?
I think, when we look at CEOs and consumers, both are, fairly confused, feeling uncertain, feeling they're questioning a lot of what's happening in the future. They're looking ahead. It's very, very interesting. Our most recent C-suite outlook that we just released within the last couple of weeks, our big annual survey, showed geopolitics as the biggest factor in what CEOs are thinking about. And some of that even trickles down to consumers. Of course, American consumers are paying attention to their own day-to-day needs. They're not necessarily following Davos, for example, or following, all of the things that we do. But they have a general sense that things are a little bit different than they have been before. And that really comes down to just a reordering of global norms, of global trade. And, I think also we've been looking closely at Canada, for example, a long-term ally of ours. CEOs are not going to move their supply chain. They're not necessarily going to start building new factories if a lot of the relationships we have with our allies, with our closest trading neighbors have not been sorted out.
And yet, to your point, Aaron, the labor market is holding up, so they can feel anxious, but they can spend. At what point, though, does just the anxiety of the potential of losing a job, be it because of a downturn in the economy, be it geopolitics, be it the rise of AI, at what point, if ever, is anxiety enough to hold people back from purchasing more?
Well, I think that we'll get a chance to find out, but perhaps we won't find out soon. We are not calling for a recession at the conference board. We have an unemployment rate that's still, just over 4%. We do think it could tick up to maybe 4.6, 4.7% later this year. But given our demographic situation and given, with our shrinking labor participation, workforce age folks, and it will take some time for AI really to show a lot of, productivity, and it may not replace a lot of workers. It may just create new jobs, we think, and create a lot of opportunity. So I'm not sure that sort of crisis moment is going to come as a result of sort of an economic slowdown or a hike in unemployment anytime soon.
Aaron, great to get your thoughts this morning. Thank you for joining us. Aaron McLaughlin of the Conference Board. Have a great weekend. David, was I sensing a little bit of guilt for ordering delivery?
I just love that veneer, that I can feel great about doing it, but...
I only feel guilty if it's like this weekend and the weather is bad.
Right. Tip well.
Extremely well. I think that is wise words to live by. Let's get an update on stories elsewhere this morning. Here with your Bloomberg Brief is Lizzie Burden. Hey, Lizzie.
Hey, Danny. JP Morgan Chase CEO Jamie Dimon earned $43 million last year. According to a regulatory filing, Dimon's total compensation increased 10% in 2025. He received a base salary of $1.5 million and $41.5 million in incentives. Dimon's one of the highest paid bosses in corporate America. Elsewhere, New York City is expected to get more than a foot of snow this weekend, with Central Park possibly getting as much as 16 inches. The National Weather Service saying confidence is increasing for a winter storm to impact the region Sunday through Monday. More than 2,000 sanitation workers will be working 12-hour shifts to prepare for and respond to the storm, with a liquid salt solution being applied to roadways across the city starting this morning. And commissioners from top US men's pro sports leagues are reportedly set to visit the White House as early as next week to discuss President Donald Trump's plans for celebrating America's 250th anniversary. Sources telling us here at Bloomberg that commissioners from the NFL, NBA, MLB, NHL and MLS will be attending. That's your Bloomberg Brief. Danny.
Lizzie, thank you very much, and thank you for all your work this morning. Up next, setting you up for the day ahead, plus Fiona Sincata of Forex.com, previewing next week's Fed meeting. You're watching Bloomberg Surveillance. 2 days of a relief rally comes to an end on this Friday as equity markets head to a weekly loss, the second consecutive one, the first time we'll see that since June. Stocks are down 0.2% in the futures session, just under an hour until the start of cash trading. Your euro also weaker this morning, euro dollar standing at 117.39. Finally, a little bit of calm in this bond market, a return to what we were used to, and that is a staid, sleepy bond market after the rupture of earlier this week. 423.91 is where we stand on your 10-year yield, while NYMEX crude peaks up 2.1% as a snap of cold weather is set to hit the U.S. as energy markets rally across the world. Counting down to the opening bell, here is your trading diary for the week. Today, we'll get University of Michigan sentiment due out at 10 a.m. Eastern. Monday, durable goods orders. Tuesday, President Trump will be speaking in Iowa, and we'll get results from American Airlines, General Motors, and UPS. Wednesday, the FOMC rate decision, followed by Fed Chair Jay Powell's press conference, plus results from Microsoft, Meta, and Tesla. On Thursday, another round of jobless claims and results from Apple. And then on Friday, results from Chevron. Turning to next week's Fed decision, Bloomberg's Michael McKee joins us now. Michael, we also got a host of data over the past couple days. What are we expecting next week?
Well, we got a little more data coming in. And the big question going into the weekend is, what are people going to be talking about more, the snowstorm or the Fed? On Monday, you'll see a lot of people out shoveling, and we probably won't have a lot of other news. But Tuesday, we get the consumer confidence. You were just talking to the conference boards, and their number comes out on Tuesday. Wednesday's the Fed. Thursday, jobless claims. And November trade will be interesting because one of the reasons fourth quarter growth so far is high is because of distortions to the October report. We'll see what November brings and how that changes the numbers. And when they get the December PPI on Friday, which will enable us to calculate what the December PCE was. Remember, yesterday we saw 2.7% for the year-over-year inflation rate. Now, as for the Fed, it's going to be an interesting meeting because they're not going to do anything. Right now, there's just a 3.5% chance, according to futures, that they do any kind of rate move. There's no dot plot. There's no economic forecast. Everybody will be looking to Jay Powell for guidance on the future, but what's the first question going to be? Is it going to be about guidance for the future, or is it going to be about his feud with Donald Trump? So there's a lot to watch there, and it will be a very interesting Wednesday afternoon.
Mike, you mentioned the snowstorm coming our way. David and I were talking with Bill Waddell of AccuWeather, who painted a frankly grim picture that it's going to be ice, it's going to be planes ground to a halt, that there's going to be freezing conditions that people are going to have to contend with. How do we look about the economic fallout of such a severe storm in the United States?
Well, there will be an economic fallout. The question is, how bad will the storm be and how long does it last to determine whether it's a significant impact or not? Of course, first thing that's going to happen is that we see from Chicago on east, all the airlines are going to be canceling flights on Sunday and on Monday. That's a loss of business and a loss of business for the airlines. We do get a bump in spending. Going into this, everybody's at Home Depot or Lowe's all around the country trying to buy generators and snow shovels and snow melt stuff. And then when we get into maybe Monday, Tuesday, there won't be much other spending. People will be staying home. They won't be able to get out. We'll see how bad the ice is, particularly in the South. A couple of years ago, there was a big ice storm in the South, and we saw spending interrupted for about a week. And then, of course, the widespread power outages that are forecast. We could see a lot of businesses have to shut down and remain shut. So it's definitely something to watch from an economic point of view as well as from a storm watcher's point of view.
Yeah, Mike, I don't think we can say it enough this morning. We really hope everyone stays safe out there. Michael McKee, thank you so much for tracking that for us. And we stick with the Fed. Fiona Cincotta of Forex.com joins us now for more. And Fiona, it's your assumption that this is a Fed that's not going to be able to cut. How long are they going to be on hold? What needs to change in order to get any movement from this Federal Reserve?
Yeah, I mean, if we think about where we are at the moment, the picture is very much that, growth is looking like it's okay. It's not doing anything amazing, but it's definitely not sort of showing any signs of concern. Inflation broader trend is still the disinflation, be it very slowly now. And then we've got the jobs market question. So if we think about the data that the Fed's going to be weighing up and what it needs to see change, it's going to be the picture of inflation and the jobs market. So, at the moment, there are signs that maybe that jobs market weakness is sort of starting to steady a little bit. Jobless claims have been coming in a little bit better than expected, which offers some optimism. But at the same time, what's going on with inflation? We saw that latest PCE data, core PCE, down at 2.8%. But again, that was the November reading. So the Fed's still also trying to sort of get through that haze of US government shutdown and clear data. So I think the Fed is going to want to see either disinflation continue at a further pace or the jobs market collapse or weaken further in order to be able to comfortably cut interest rates again. And I don't think either of those are coming through at the moment. We're potentially not going to be seeing that until around the June period of the year.
Fiona, there's been a chorus of policymakers and analysts who have been counseling us to pay more attention to what's going on in Japan. And this morning, I think, is another reemphasis of that. We've seen the move in the yen on the heels of that BOJ meeting. What's your interpretation of what caused that and what that signals here to the broader global market?
Yeah, so what's going on in Japan, I think, is really interesting. Obviously, we had the BOJ yesterday. They left interest rates unchanged, as expected, after hiking rates to 0.75% in December. It's the highest level since 1995. So rates are high there. Interesting, we saw that volatility in the yen around that decision. Now, I think that really caught our attention because this just highlights the level of nervousness, I think, in the market with the yen at that level against the US dollar. So we're trading around that 160 level, which is close to that intervention level, which is broadly seen as that sort of red line in the sand, where there could be a potential intervention. Now, we did see the yen weaken after this decision from the BOJ. Again, interesting because the BOJ was almost taking they have an undercurrent of a hawkish stance, and yet we saw the yen weaken. And that's because of those concerns over what's going on fiscally in Japan. We've got, obviously, the bond market in Japan has seen a lot of volatility recently. We had those 40-year yields at record highs earlier this week. So there is a lot of concern over that. That's causing that weakness in the yen and just creating a sense of uncertainty towards the currency.
Very quickly here, let me ask you about dollar weakness as we talk about this Sell America trade on the heels of what unfolded in the Alps this week. What are you watching for here as we move into the next week?
Yeah, so this dollar weakness story is really interesting as well, right? Because we saw it come off, even though it can potentially be a safe haven, often is a safe haven, but obviously because of how close the situation is towards, the US economy to Trump, we saw that sell off and Sell America in the US dollar. But we saw it continue to sell off, even as the picture surrounding Greenland improved. And I think that's really interesting. I think it does raise some questions as far as policy uncertainty is concerned. From the Trump administration, potentially even questions over credibility, given that sort of repeated taco trade that we seem to be seeing. But going into next week, I think the market's going to want to be moving away where possible from geopolitical and moving back its focus towards Trump, towards the Federal Reserve, towards data, and back towards those typical drivers that we've been normally watching.
Fiona, thank you so much. Fiona Cincotta of Forex.com, a StoneX company. Coming up on Monday, Russ Kostrick, Sarah Hunt, and Bob Michael. David, it's been wonderful to spend this Friday with you. Good
Stay
luck
safe,
this
stay
weekend.
warm.
Yep, stay safe, stay warm. The motto, the mantra for the next 3 days. This was Bloomberg Surveillance.